Hey guys, thanks for subscribing. Almost 90,000 subs. Make sure you subscribe. Quantum dumped yesterday. It looks like it's dumping today too. Nvidia. I'm tired. I didn't get a great night of sleep, but c'est la vie. No, I don't watch Beyond Meat anymore. I've moved on to better things. Pathetic. Ape strong. Ape still strong. Yeah, market breadth is kind of bad. Nvidia is the only stock doing well. Although, at least today, I mean, most we're at an all-time high. I mean, all the other stocks are still up a lot. Just talking about right now, I guess. Yeah, well, Nvidia, right after we left and went to OpenAI, Jensen was still talking, and he was talking about robotics, and I thought that would be that, but it turns out that he said that bookings for the next 5 quarters were 500 billion. Now, a lot of people are trying to figure out what this meant. Does it mean that next 5 quarters of revenue are 500 billion? That would be well above consensus. So it's really not clear, what the story is there. Spruce is up from $30 to 120. So I don't know what you think getting wrecked is, but okay. Um, is down from the tippy top. Volatile biotech. I'm short Joby here and there. Let me see. What do I want to sell right now? Short some IonQ. I'm short a lot of IonQ. I wasn't really nervous for TV. Spruce is a bigger market cap than that. They raised shares, but they sold shares. It's made something like 100, maybe. All right, D. Sorry, man. It's fallen a bit from where you bought it, probably, right? I bought it at 30. Did you buy it at 200? Yeah, some of you guys seem a little over indexed, a little over invested. I haven't tried Grokkapedia yet. Okay, so what are you worried about? Stock goes from 130 to 120, you start panicking? Yeah, you got to go to meet Kevin, man. I'll buy a little spruce just for fun. Studio lighting, that is true. Yeah, I really should have bought that INBX. Or held it, I should say. Yeah, I do have to do updated, but I need like a content creator to help me, or like a producer or video person. Abivex, flirting with 100. Who knows? Maybe it'll get bought out. That's what a lot of people are hoping. But who knows? Citadel and Renaissance, very different companies. About as different as it gets. And yeah, you're probably not going to get into Renaissance anytime soon. Renaissance, they call you, not the other way around. Yeah, if you want to learn about pharmaceuticals, I think the best way to do so is try try reading 10Ks of drug companies and biotech companies. You'll probably learn something. No, I didn't see that lander. That's so funny and weird. There are a lot of similar places to Renaissance. They're pretty small. Like Citadel is a big institution. Um, there are a lot of smaller quant firms that are still very successful. But they're almost like more family style. It's a very tight, small group of guys that have been working together for a long time. Citadel's more of a meat grinder. Vlad's got it. Oh, great. We got a math PhD. Wonderful. I was learning about sheaves yesterday. Sheafs. Sheafs and schemes. I know about schemes, but not that kind of scheme.
Top news alert. Trump heads to South Korea to face trade talks and North Korean missiles.
Yeah, cut your losses for Spruce, please. Leave me alone. This fucking guy. Yeah, I mean, why do quant firms not give equity partnerships? I mean, they do if you're a co-founder. This guy, do you think Citadel bought SPRB for the FDA approval play? What FDA approval play? What are you talking about? When you buy a company stock, you're buying, it's kind of like you're buying a portion of the company. It's like a share of the company. And the asset of the company, in the case of a drug company, is a drug. And sometimes, at least my experience, I buy shares of the drug companies when I look at the drug and I think it's undervalued relative to what I'm paying for. And that some people call investing. I'm short Capper because the drug doesn't work. This shit don't work. I warned you bitches. Yeah, chiefs. They're the chiefs, darn it. Chiefs and schemes. And if you got your hair cut like mine, I feel sorry for you. Nvidia is really hard to tell what's going to happen. I mean, in some ways, it's going to. You know, it really depends on what this super cycle looks like, but and will the cycle end? You know, could it be a 20-year super cycle? It happened to Intel. Okay, quantum is rallying here a little bit. Nvidia, you know, making all-time highs, $211 now. Yeah, could be fatty. Yeah, I don't know why Nvidia is trying to sell the quantum, because I think that, quite frankly, quantum doesn't have the money to really help Nvidia too much. It's kind of a they're not they're not big enough. I hate to say it.
That drug pharmacy dude, Martin, what's his name?
Martin Shkreli.
Shkreli.
It's pretty different to look at financials on a terminal like Odell. You just do FA. Also on Bloomberg, you can do CH1, and you can look at financials, but you don't really. That's not what a modeling is. Everyone wants the shortcut. who once told Alexander the Great, "There's no golden road in mathematics." I think that's Euclid said, "There's no royal road to geometry." To King Ptolemy, not Alexander the Great. King Ptolemy demanded from Euclid, "Teach me geometry the easy way." Said, Sir, there's no golden road to topology."
China.
I guess I could trade around some positions. I hate doing this. Trading is like a lot of times when investors try to trade, they make things worse. So I have one short that's down a little bit, and some other shorts that are up a little bit. So I figure maybe I could dart in and dart out like a bandit here, but I'm sure I'm gonna fuck it up. Usually, what happens is when I cover the short that I was shorting, I shouldn't have covered it because it's actually going down fast. And when I try to reapply it to some of the other trades I'm in, well, those trades, they're up for a reason. They're working because I don't know. They're what's up? No, I'm good for now. I ate earlier. Thank you, man. So let's see. Do I buy some puts or let's see, maybe some puts on Brigetti? Brigetti is such a joke of a company, man. They were featured yesterday. I have Rigetti 45 puts, which is a little. I made some money on those, it looks like. Let me try. Let's see here. I always like buying D-Wave puts. I got 40 puts, 39 puts, 38 puts. The stock's at 33. Might as well, I guess, buy 37 puts. Any kind of short exposure to D-Wave is always smart. This company is like the biggest clowns of all time. They didn't even get mentioned out of 17 companies on Jensen's screen. They couldn't get mentioned once? Come on, bro. Who does that? You can even get a little shout out from Jensen? He's willing to shout out these shitty tiny companies. You couldn't even get a little love from the Big J? Come on, dude.
Top news alert: Nvidia storms past $5 trillion valuation as AI boom powers meteoric valuation as AI boom powers meteoric rise.
I have two Godels open because I'm doing some debugging and whatnot. Yeah, I'm trying to get the guys to agree to basically put the company on hold so we can play Rust. And just start, having monitors all around the office. I don't know if you guys know this, but yeah, it's this like weird survival game where you build a base and you kind of like live in the base. And if you're like me, you spend more time in the base than you do in real life. So like it becomes your house. And the problem is if somebody tries to raid you in like the middle of the night, you got to really be awake. Oh, there he is. Just telling these people about Rust. I'm telling these people about how Rust works. So yeah, I love Rust. And so I was thinking about like getting computer monitors all around the office. And can we install cameras in Rust and have them be the monitor? But like if I had a computer monitor right there and it was like our front door of our base, I can like have a view of that. And then like how about like can we remake this office in Rust where like the screen here and like this office is in Rust? Forget the time, just in general, recreating this office in Rust where everyone has like their seat. Yeah. And the monitor in real life is like facing, like I look at the monitor in real life and it's the same view, from like I can sit in my chair and like be like, okay, I can see that, and then I see outside the base in case somebody's invading, you know. maybe maybe spend more time building Godel stuff, but there's Rust, the programming language, and then there's Rust, the video game. The problem with Rust, the video game, is it's very addictive. I'd suggest you guys don't get involved. Yeah, it's nothing changed on Spruce. I'm bidding for some. I think I got filled. I bid 119, so it must have gotten filled. Pretty sure. Let's see. Yes, I got filled. I can bid for some more. I don't want to make it too much of a position. I mean, I'm happy with the position I have. Just because the stock goes down in your portfolio, you shouldn't be like, oh, I'll have to buy more. You could also just wait. Yeah, I got a couple good nights of sleep, but we do some real analysis soon. Yeah, but basically Rust is like toxic shit. Like don't ever play it if you can help it. All right. Let's do one of these. Let's do a poll. This is the most toxic game ever. All right, let's do a poll. Poll is up. Vote. Yeah, I kind of do want to look at Pfizer. I agree. Non-local qubit connectivity. You guys familiar with the concept? Hmm. Sam Altman played Dota? I don't believe that. Oh yeah, Xtropic is doing their thing today. We're excited about that. Oh yeah, we gotta do Biohaven. You want me to look at Google? Google and Nvidia toss up. Oh, Nvidia's now in the lead. Yeah, Kotu's kind of been bearish on Google for a while. Trading momentum works pretty well as long as you have an itchy trigger finger to get out when it goes against you. Yeah, Terraria, that sounds more right. I can ask around. I'll get the answer. Kythera? Novo? All right. This is neck and neck, Nvidia and Google. We can always go back to back too. Back and forth. Yeah, really wild situation. Google's Nvidia's at 5.1 trillion market cap and enterprise value, and that cash is 45 billion. We're gonna look at their uses of cash and stuff like that. Let me try something here. Okay, just gonna kind of use this sheet, which probably should be familiar to some of you guys. Let me do like an earnings section. Is this? Okay, can I do like calendar year earnings per share? We'll do like, I guess 2020. I mean, we should do all the years theoretically. 2020. Let's just do 2025 forward. Don't need to go into more detail for now. Okay, and then we're gonna do the same thing here with EV to earnings, which is kind of my favorite metric. Enterprise value divided by earnings per share, or enterprise value divided by sort of net income. Let's try that. It's EV to E, really, EV to earnings, but net income and earnings is the same thing. In college, I used to call it NOPAT. Net operating profits after tax. You still might hear that sometimes. So anyway, Nvidia's on a weird fiscal versus calendar. So like theoretically, if you add up all the quarters, they have one more quarter report this year. So their earnings are 81, 89. No, wait. 89, 96, 105, 125. 96, 105, 125, 142. That's 468. Very confusing how to do this because if I want to include, I could do the fiscal year too, but I think that's a little unfair because it sort of skews the numbers forward once. So we'll do the April quarter, July quarter, October quarter, and Jan quarter. I mean, I think that's the right balance, but I'm not getting the numbers to add up to the numbers I have here. So, okay, that's sort of right. It's very annoying.
That drug pharmacy dude, Martin, what's his name?
Martin Scully.
Scully.
Okay, I think this is it, but we'll see how it goes. Now the calculation for EV to impute it from EPS is a little tough because this is EPS. So I need to kind of manipulate it a little bit. I'm going to do enterprise value divided by shares outstanding and then divide that by earnings per share. But I need to do my order of operations correctly here. Still got something wrong here. Let's see. Yes, number of zeros. Maybe even more zeros. Maybe quite a lot of zeros, it looks like. Because this is in full dollars. And this is, they have 24 billion shares outstanding. We're going backwards. J4 divided by, I guess we have to make more parens here. Okay, there we go. 46 times this calendar year. But this calendar year is mostly over, so we don't really care about this calendar year. We're going to freeze J, freeze G, and let the rest go wild. So 32 years next calendar year. I wonder if we should do revenue too. Just to, you know, just to sort of have it. So we'll do revenue, price to sales or EV to sales. And then I want to do revenue growth too. We'll have to leave out the first year because we don't know what it is. Okay, and then we'll make little borders here, pretty little borders. Does not feel like Bob Ross. Happy little trees, happy border right there. He's not happy. Happy little border here. Not too big into how these look, but you know, you got to be presentable at least. And you can actually download this on my GitHub for free. So many people have learned finance from me on Wall Street. It's not even funny. And that's why I'm still able to run a business on Wall Street and still interact with people on Wall Street. I'm just very, very blessed that many of you have my back. And I really appreciate that. You know, when somebody says something bad about me or something like that, you guys jump up and say, no, he did nothing wrong. And I really do appreciate it. That's, you know, I won't take that for granted. All right, so the street continues to raise numbers for Nvidia to the point where we're pretty. Okay, EV divided by sales is going to be a little easier. Oops. Let's do it like this. Oh, too many borders there. That's not happy border. Again, order of operations, so important when you do these. All right, so 26 times sales. Again, when you have a high margin product, price to sales tends to stop making sense. So just be wary of that. You know, sales or EV to sales in this case, you know, it doesn't really always have to, like that looks crazy, 26 times sales, but when you remember the margins on the product, you realize that, oh, actually, it's basically, you know, 50% net margin. So, all right, let's freeze J, leave Y. And you can see the price to sales drops as the company expects some substantial growth there. Let's calculate said growth. We'll make one happy border here. You know, none of this will really teach you how to be an investment banker. Like, that job is, you know, my skill set here and kind of what I teach you is more buy-sider stuff than sell-sider. But there are some other places you can go to if you really want to learn the nitty-gritty of how to make good Excels and PowerPoints and stuff like that. Like, on the buy side, that's a little less important. You know, we're mostly trying to make some money. All right. So there's Nvidia's projected revenue growth. You can see this is Wall Street consensus. Doesn't always mean everything, but you can see the 39% projected growth, 22%, 7, and then 13, reaching about 400 billion in 2029. I think they'll beat that. In fact, again, if you take Jensen at face value, he may do 400 in 2026. Okay? 2026. The street has him doing 400 in 2029. Can you imagine? Now, the problem with Nvidia isn't, are they doing well? We all know that. The problem is, what's the sustainability, right? That's the main issue. Are they going to be able to actually sustain this for time, you know, time immemorial? And I think, you know, one of the things I want to look at here is actually, believe it or not, Intel. Now, I do want to shout out SemiAnalysis, who's got some really great semiconductor stuff. If you're really serious about semiconductors, you got to read SemiAnalysis. It's worth its weight in gold. It's very cheap, actually. They could be charging 100x what they charge. And in fact, I think you can read it for free, which is crazy. So this is Dylan Patel and his group. And there's no contest. You know, in the past, you would want to read, and I'm not being paid by them. I'm not partnered with them. I'm just calling a spade a spade. You know, you'd want to talk to guys in Asia. You'd want to talk to the big banks on Wall Street. At this point, I mean, they really have the game on lock. So we'll probably read some SemiAnalysis. I'm probably going to try to spend an hour on Nvidia if that works for you. Now, again, you know, when we look at DCFs, we're trying to understand what this is the most important thing to any DCF. Okay, this is the most important thing in investing. Really, is what is the steady state earnings? And how do you define steady state? Well, the reason I call it that is that many companies are not in a steady state, and some companies, by definition, will never be in a steady state. And some people call, instead of steady state, you call maturity. You know, Dermataran has some interesting definitions of this. You know, what's a company at maturity? What's the growth at maturity? And so forth. But, you know, when you have a company that's the products are planned obsolescence, right? This is the V100. This is the A100. This is the H100. This is the B100. You know, not exactly drawn to scale, but, you know, maybe it's something like this. You know, and so V100, A100, these are Nvidia chips for anybody that doesn't know the lingo. These are the H100s. This is the B200, and then we have Rubin coming, which we don't know. Maybe Rubin's like this, right? And so you have this like planned obsolescence. So what's steady state doesn't make sense here. Whereas for Coca-Cola or something like that, it's a lot easier to value because you can sort of say that, you know, the company, you know, started, had a big growth spurt, and, you know, revenue sort of reached this sort of steady plateau, you know, of small growth. And maybe one day we'll have some decline. We can sort of model this. In calculus, this is called the area under the curve, right? We can just say, well, what's that, right? What's that AUC? What's the discounted AUC of those cash flows? Here, you get something a little different. It's the cyclicality that you have to understand. And the cyclicality is not just the product cycle, it's the business cycle, right? So you have a bunch of different things there. And you have a technology cycle now that's, you know, a little bit difficult to understand. And we're going to try to figure this out, but it's not going to be easy. And it requires some creative thinking. And in some ways, investing is a little like philosophy, where we don't really know where we're going. And part of it was we were trying to scope that out and figure out what to do. Checking back on the market, we got a little bit of a rally in our hated quantum sector here. So I actually want to look at, for a long-term perspective here, I kind of want to look at Intel, and I want to go back really far back in time for Intel. What the? Okay, Intel stock price has changed quite a bit since I last looked at it. We were relatively bullish on it, so I hope, you know, somebody made some money. Much higher market cap than it once was. Rockets up the list from 140 largest market cap to, say, 61. Good for Intel. They have some net debt, so the enterprise value of the company is actually a little bit higher. 17 in net debt. So it's actually a 194 billion. I'm going to move this. Actually, I can delete that now. I might leave it for now, but let me see if I can. Yeah, Nvidia's success is incredible. All right. So on Intel, what I'm really trying to figure out is, you know, I think for Intel and Micron, I want to look at the semiconductor cycle. And this is something that has sort of doesn't exist anymore for Nvidia. And that's where I kind of want to make sure that we haven't made the awful mistake of which happens in finance sometimes. Basically one of the biggest mistakes you can make, which is you mistake cyclicality for permanent growth. And I don't want to do that. I know you don't want to do that. So we're going to try to figure that out. We haven't looked at Intel in a while. We kind of saw it as this kind of boring value stock that probably had some upside. They obviously had sort of a really, really big W or two. I'm going to close Nvidia for now, believe it or not. Even though we're looking at Nvidia, what I really want to do is understand long-term semi-cycles. And I'm going to go back in time. And I'm also going to do the same thing for Micron. And it's going to be a little tedious, but, you know, learning the history of your business is so important. Every time I talk to guys, I'll give you another example. You know, in biopharma, I kind of became like one of the most well-known guys in biopharma and one of the sharpest before the pharma bro bullshit, because I kind of tried to learn every company in biopharma history, including companies that have long been gone. And I did a funny analysis. I don't know if I have the file on me, but I did a historical biopharma. You know, let me see if I have it, because it's so interesting, I think. Give you an example of the lengths you have to go through. To really claim you understand your industry, I mean, you have to eat, breathe, and sleep it all the time. Here it is. I found it. Great. So this tracks every pharma merger from 1849 to modern time. And so these are all the companies that merged into Pfizer to create Pfizer. William R. Warner and Company. This became Warner Lambert through the merger of Lambert Pharmacal Company. That became Warner Lambert. So William R. Warner Company was founded in 1856. Lambert wasn't founded until 1881, but eventually they merged a long time from now. They renamed William Warner Company Warner Hudnut, and they merged in 1956 to create Warner Lambert. Meanwhile, unbeknownst to anybody, American Home Products was founded in 1860. John Wyeth and his brother, John and Frank Wyeth, were founded that company in Philadelphia. And Arist, McKenna, and Harrison Limited was founded in 1925. American Home Products merged with Wyeth by just buying Wyeth, Stuart Wyeth, who was John Wyeth's son or brother, his son, died, left Wyeth to Harvard, of all places. Harvard sold American Home Products to Wyeth, or Wyeth to American Home Products, creating the bigger AHP. Now, if you've been around the industry, AHP was still public around 99, 2000. I used to trade AHP. So this is 1931. And there's Airst. American Home Products acquired Airst, 1943. So 1944, you have fairly big American Home Products. We're going to put that on hold for now. And again, the point is, like, slowly but surely, Warner Lambert was public. It was WLA. Pfizer, if you notice, Pfizer's this little tiny guy in 1849, right? And all these other big companies are being created around Pfizer. So Pfizer's doing just about nothing. And then finally, the Pfizer-Warner Lambert merger in 2000 creates a major company. But Pharmacia was already, kind of developing, and American Home Products was developing. So the big deal in 2004 was Pfizer buying Pharmacia. Pharmacia was PHA. And American Home Products was still public, changed its name to Wyeth, of course. And then the monster deal in 2010.
To decide whether Trump legally deployed troops to Portland.
So Pfizer kept acquiring little companies like Medivation, Arena, Biohaven, Seattle Genetics, and that's where we're at in 2025. I have a few more of these to make, but the point is, knowing your industry's history is something that's important. I also know the drugs that these companies made. Warner Lambert was actually the inventor of Lipitor. And if you know, the more history you know, when you meet people, if you know the people behind it, it's obviously not important to know the people from 1850, but who was the CEO of Warner Lambert? Is he on any boards right now? Is he giving any talks? Maybe you can go to a talk. And, the CEO of Warner Lambert talk is going to have 8 people attending it, whereas the CEO of Pfizer talk is going to have 300 people attending it at your local college. But you could probably, get a word in with the guy who was the CEO of Warner Lambert if he visits your college. So the point is, knowing all these names actually makes it, a lot easier to network, and when you bump into somebody, it helps. So Intel, it's no different in any sector. So in financial technology, which I'm somewhat new to, I have a financial technology startup. I've been studying the how S&P Global, for example, was made through mergers from McGraw-Hill. And, it was a very fascinating thing how S&P Global became what's basically the largest fintech in the world now, bigger than even Bloomberg. So knowing the history of all that, I think, really, really helpful and important. So let's see if we can get the revenue from Intel from as far back, basically, as we can go. And I just want to see kind of how Intel navigated this, like, cyclical growth thing that happened to them, because it sort of feels like in some ways the same thing here, just a much bigger, obviously, inflation adjusted, and in other ways it's a much bigger kind of situation. So let me see if I can get the 10K we're missing, which is 2005. And again, this is all really helpful if you're gonna make your name as a pharma or biotech or semiconductor analyst. Like, you should know approximately what was the size of Intel in 2005. What was the clock speed around that time? What was the wafer size? What was the the etch size, the technology size? How big was the transistor at the time? Where did they make it? All of those things, you should understand and know your history. Now, it's more important you know the present details, right? But don't skip out on the history, because that's one, it tends to repeat itself, and then two, no man is an island. I mean, you have to meet people, shake their hands, get to make contacts, be friendly. And when you share your insights, people say, well, that guy really knows his stuff. He needs a haircut, but he's good at that. And that's the kind of thing that, will benefit you greatly. So study your industry as hard as you can, and I guarantee you'll make some success. All right. Yeah, Intel, like a lot of other companies, spent a lot of cash buying back shares instead of buying other companies. Intel reduced their share count here from 5 billion or 6 billion, 6.5 billion to 4 billion. Well, it's great for the shareholder, but they much rather would have bought Nvidia. Right? And they don't have to buy all of Nvidia. I mean, this is the funny thing. Companies really are dumb when it comes to this stuff. I think corporate America has this terrible disease where they don't understand that, like, you can buy unsolicited 5, 10%, 15, 20% of a company. Nothing's stopping you. Nothing's stopping you. There's a company you admire in the sector, buy 10% of it. What's the big deal? But there's this frustration that, most CEOs don't know how to invest, and they don't want to learn how to invest, and they don't trust anybody else to invest. And the boards are no good about it either. And it feels like, it's not the real core use of cash in the first place. So why do that? Well, what's a buyback? What the hell is a buyback? Buyback is just a tax-free dividend. And we're going to see if we can put plot Nvidia's revenue onto this as well. But let's go down to 2002 now. We're going to see what years there was some. I'm going to probably put them in gray or something. I don't know. Let's try that. Light yellow. Light red. I don't know. Some cyclicality here. Let's keep going. There's also a time when these companies stopped reporting their annuals in the Form 10K and actually had an extra attachment somewhere else. Okay, so here's another big cyclical period. This is the period I remember very fondly because it was really disastrous. And it probably set the stage in many ways for NVIDIA's ascent. It began the ascent of NVIDIA. They were obviously unrelated, but NVIDIA was kind of lying in wait here. And probably the distraction of this big cyclical drop where, people were really scared. I mean, there was a question of how far back would we backslide economically? And, when would the pain end? Everyone was talking about the hard landing, soft landing, V-shaped recovery, people worried it was going to be L recovery, no recovery, just drop and stay down there. So, it was a bad time at the time. It's really not great. And, fear tends to pervade, in times like that. So Intel was really profitable in 2000, but it was also the beginning of the end in 2000. All right, so let's keep going here. And again, they had 7 billion shares outstanding. They decided they wanted to, use all this cash. I mean, every year, 8 billion, 4 billion, 4 billion, 7 billion, 8 billion, 8 billion, 3 billion, 6 billion, 7 billion, 5 billion, 11 billion, 12 billion. What'd they do with any of this cash? Nothing. They bought back their shares at prices that were way too high, that would end up dropping. You buy back your stock if you think it's cheap, but what the hell do you know about investing? If you knew anything about investing, you would have bought Nvidia stock. So, it's just kind of this, corporate America is terrible at strategy and mergers and acquisitions. And sometimes, you'll get a CEO who's really good and they'll actually deliver the goods. And they're just brilliant and they know how to do both. But, investing traditionally is one thing, but then deciding, okay, this is a great company, I want to have a part of it. That's kind of a different job altogether. So look at the big boom here. This was like massive boom time. Look at the revenue. No, wait, hold on. I have this was a big boom time. But revenue jumped from 25 to 33 before cratering a bit. 25, 070, 26, 273, 29, 389. And then again, you had this big decline. Let's see if I can get rid of this. But that was a big stretch. I think there was another cyclical period in 94. But let me fill these out real quick. Take 2 seconds. And there was a split. Stock splits were also in vogue at the time. Americans wanted cheap shares. Nobody wanted $1,000 share. Now it's the opposite. And again, 7.2 billion shares outstanding, all the way down to 4 billion. Huge waste of capital. But again, a company had no idea what to do with the rest of their money. They could have gone into they could have gone to foundry. They could have gone into manufacturing equipment. They could have gone into anything but what they did, which is, take their stock and buy back shares. Yeah, it's real cringe stuff. But again, easy to say with hindsight, right? Easy to say, oh yeah, what I would have done was this. Well, you're not Andy Grove, I guess. Who were the CEOs of Intel? Andy Grove, Craig Barrett. That comes to mind. Does anyone remember that name? Sort of different tenures. All right. So here is the mega growth. So 20% growth there. So this is kind of analogous to maybe what Nvidia is going through now, this period, the 90s. But I want to go back even further. So yeah, here's the 40%, 20%, 29%, 20%. This is Windows 95, Wintel dominance. Revenue grows from 11 billion to 33 or 34 billion. Now, we know that Nvidia did way more than that, right? So we're going to see if we can, no pun intended, parallelize. Nvidia makes parallel processors. Parallelize this a little bit and see if we can find some interesting parallels. But there's actually a term in data sort of engineering where you're trying to, let me see if I get the split amount. I think it was maybe 8-for-1. Where you're trying to get time series to fit over each other, and you adjust them slightly so that pauses or delays in those time series can get sort of swallowed up and recreated. All right, so 96. It's probably 8-for-1. And it's funny, they did better when they weren't buying back stock. When they were letting their share count grow, buybacks are kind of contrary indicators. When they're doing buybacks, well, that was the top, because when you got nothing to do with your stock and you're not growing fast, buybacks are kind of oh. Again, very, very cringe. I mean, you're buying back your stock at the height of your success. What do you think is going to happen? And it may look smart in a few years, but does it look smart in 10 years? Does it look smart in 20 years? That's kind of what matters. And that's where I think I'm going to really understand where Nvidia is going here. And it's not easy, right? It's not going to this is going to give us the answer. This is going to give us a clue if we're lucky. So we have a wrong number here. 406, 415, 273. Okay. Scene. Got it. All right, let me double check this split. It must have been 8 for 1, but I just want to. There was a 2 for 1. Another 2 for 1. I don't know. I'm just going to assume that was it. The numbers add up, so. Oh, yeah. Yeah, two for 1s. I don't know. It has to be right. Let's go back to 93. I am 10 years old. So I'm reading gaming magazines, PC magazines, and things like that, but I don't really know what the hell is going on. And Intel, a much younger company here at just 8 billion in revenue. And look at this. Look at this. This really does maybe remind of Nvidia, because let's just do this for a second while we fill these out. So 91, 92, Intel in essence is growing like a weed. So 20%, 22%, 50%, 31, 41, 29, 20, 6 years in a row of massive, massive growth. So maybe I'll color that light green. Then you do have this slowdown here, right? 98, there was a stock market crash in essence. Even in 94, there was some Asian contagion, but that didn't stop Intel. And 99, 2000, the growth was again double digits. And it's good to save these because, I mean, once you've done it once, you have it forever. If you ever want to look at AMD, you can kind of get a sense from the AMD Intel wars of yore. Okay, and here is another split. So 16 shares go 16x. Incredible what splits can do. And again, the share count's going up, not going down. They're not buying back shares. They're letting the options grants dominate. And, company thinks that, oh, well, once we have tons of cash, we can buy back those options. But it's like, actually, you're better off just issuing lots more, getting your workforce organized and excited about the next thing you can do. Intel wisely always avoided quantum, by the way. They have a small quantum group, but they always were suspicious of quantum, which is the one thing they did right. But they got into a ton of missteps. They kind of got into Ethernet networking, and that never became really big for them. And we all know Intel's missteps, and it's easy, again, to say, in hindsight, what happened, what went wrong. All right, so we have all the way back to 94 here. It's going to be a little tricky to get maybe more. We'll try. My databases aren't exactly cooperating, but I think I can do it. Might have to go to the microfilm for this one. All right. That's odd. Internet's your friend, right? You could just search. Intel 1990 10K. Ah, Intel has a historical archive on their website that goes back. It's kind of memory lane. This is what you used to do, and the college I went to, we had a reading room of all these old annual reports. So you'd go find them there or something like that. Bob Noyce. One of the Treacherous 8 or Treacherous 7, what was it? There's Craig Barrett and Andy Grove. I don't know microprocessor lore, but there was the Fairchild. "32-bit systems." Okay, here's our income statement. All right, so again, some lovely growth here in the 90s, early 80s, or early 90s, late 80s. Again, kind of reminiscent of Nvidia's scaled differently. I mean, that is 0, I guess, because the world economy was just less mature at the time. What am I doing here? I'm missing a year. There we go. And now we have to scale the shares outstanding by 32. They've split so much that you got 32%. 32x, excuse me. Shares outstanding growth. So, buybacks in the scheme of things didn't even dent those in a way. And now you see shares outstanding kind of growing rapidly instead of shrinking rapidly. It's very telling that, you had this dilution that occurred as they grew so fast and their employees, got all these stock options that no doubt, there were many Intel millionaires made. If you were walking around Silicon Valley and so I was at Intel, I'm a senior guy at Intel. I was there for the last 10 years. People would say, oh, wow, that guy's got to be rich. Doing real well. Now you say something like that and you say, oh, poor guy. Feel bad for you, pal. They got a boatload of worthless Intel stock options. All right, so 2 more 20% years. So basically Intel had 1, 2, 3, 4, 5, 6, 7, 8 20% plus growth years, including a 50 and a 40. But 89 was a little slow. And again, when you're growing that fast, just growing 9% is actually kind of I would say that's a cyclical downturn. But let's look at 87. Intel goes back far. I mean, this is the company that made the microprocessor, so we got more and more and more to go. It won't be too long if you can't wait. Cover photo. If you can't wait, you have ADHD. The investing takes a while. Intel's most advanced microprocessor, the 8386. This is a 386. 1987. I was 4 years old. I was playing on Apple IIe's maybe, but not this. 275,000 transistors. There's trillions of transistors now. Capable of running DOS and Unix simultaneously. Woo! And also takes advantage of software developed for the 86 series. Major growth at this era too. And here's actually, in some ways, all that we want right here. So maybe we can... I hate to cut this short, but I know a lot of people have ADHD. So let's just... This is the kind of stuff I really enjoy. It's crazy. All right. 1265, 1365, 1629. This is what it takes to be good, in my opinion. 1122. Now, this is Intel's first $1 billion year. $789, $855. Here's a period of very slow growth there. And again, some of this is product and some of it is the economy. All right, so 51% growth that year. And some of it is shipments and stuff like that. I mean, but you can see here there was some serious slowdowns. Here there was the 8586. What happened in 8586? Anybody remember? Was that the crash? Is that the 84 crash? Okay. So, Intel, this is sort of reminiscent of Nvidia, right? Growing from 400 in revenue to 4 billion. That took 13 years, and then 4 billion to 40 billion. Maybe a little less successful than Nvidia, but still meteoric kind of success. Some years, early years, they're going up 60%. And again, we're not done. There were microprocessors. Well, this is around the time Intel got founded. We're getting pretty close to the start of the company. So let's see how they overlap. It'll be kind of interesting, at least. It was the first product, the 8086 or 8088 or 4044, something like that. I forgot what it was called. But let's check out this guy. And see if you think this matches what Quantum looked like. Large scale integrated circuits. Okay, yeah, here's all the rest we need here. So 78. $1969, 600,000 in revenue. Okay, let's see if we can overlap Nvidia here somewhere. Ah, there we go. There's a few ways to do this, but let me do it. This way. Okay. I have to go back in time more for Nvidia, or let's see if I can get Nvidia's 99, fiscal or 2009, 1999. Nvidia 1999 annual report or 10K. Well, that's just on SEC.gov. 99, Jensen Huang, 39 years old. Marvin Burkett, 60. One of their CFOs went to jail. I don't know if it was him or not. But it's funny. Do you know any of these people? Does anybody ever heard of any of these people? Jeffrey Fisher, David Shannon, Dee Ma. It's a very interesting point that whom amongst us remembers these? Okay. 99, they did 158. I'm just going to leave that there. 99, fiscal year 99. Let me see if I can get fiscal 98. Nope. Well, maybe this will give me revenue if I look far back enough. No, I don't think so. Xbox was a big product, I guess. Do they go public then? I'm going to try SEC.gov, see what happens. SEC.gov is a little busted right now, actually. 10Q, but not 10K. What the fuck? Okay. There's the S1 for Nvidia. That might have the details. S8. Maybe first S1. This will be fun to read. The head of Wilson Sonsini was still Larry Sonsini. It's a big law firm. They're raising $40 million. Can you imagine? That's a seed round today. Nvidia designs the Riva 128 graphics processor. I'm going to throw that in my model just in case I ever meet an old Nvidia guy and say, do you know what the Riva 128 was? Was that any good? Let's see. What was this? 1996? 8. March 6, 98. 1998. Well, I guess they reincorporated in Delaware, filed IPO, Riva 128 product. Wonder how many transistors that had, or if it was doing parallel processing. Okay. Okay, here it is from Dawn of the company. Oh, they had normal fiscal years back then. Didn't know that. So, okay, let me see. Well, we should be able to recreate the whole thing. I don't know when they went to a bizarre fiscal year, but 12/31, 1997. $3 million in revenue there, $1 million in revenue there. Fiscal year 96, fiscal year 95, 12/31/96, 12/31/95. Okay. It's the first. Okay, here's a 10K. It's 10K 405. Sometimes they had these weird appendages. Then I had the Riva TNT. I kind of remember this thing? Kinda? Accelerated graphics port. Okay, it says invention of the GPU 1999. I don't know if that's right, but regardless. Riva 128ZX. I wonder if you could find one of these on eBay. Somebody can find one of those on eBay. Maybe send it over to me. I'll buy it and frame it. SGI. Everyone in Silicon Valley should know what SGI was. Wow. January 31st, 1999. We had 248 employees. Jesus. Can you imagine? Imagine quitting. I don't like this. Making video games. It's silly. Jensen Wong, 36. Oh, to be 36. Chris Malachowski. What's he doing right now? What's Chris Malachowski doing right now? Let's take a look. Boss. You're American electric engineer and billionaire businessman. Oh, wasn't this the guy that invented CUDA? Isn't this the CUDA guy? He co-founded Nvidia in 93. Okay. I'll write his name down. Isn't he Mr. CUDA? Co-founder. Okay, let's take a look at who else. Christine Hoberg. Oops. Oh, this is the... Oh. This lady stepped in shit. How many other CFOs got charged with shit? Like, I think this is two or three times. Nvidia was lagging behind expectations. In order to meet those expectations, they entered into agreement with supplier. Yeesh. Sucks that she's now known for this, right? Okay, Jeff Fisher. Senior Vice President at Nvidia. Jesus, look at this. Look at this guy. Experience, Senior Vice President, 31 years. This guy's still there? Director of Sales. He was at Adaptec. Really funny. The hell? No photo. Just... Can I follow him? Maybe let's see if he can... Well, maybe he'll connect. Who knows? You never know, right? Nvidia's first salesperson. There he is. Before it had any products. At the time, Nvidia employed 25 people. So technically, he's employee 26, right? And again, these people are still alive. You can call them up. You can find them. They're not, you know... I'm sure some of them are friendly. Don't go knock on their door, but... Mark Allen. This guy's unknown. Unknown. It's got just such a generic name. That's Inglewood, Colorado. Is this the guy? Okay, no, that's definitely not him. I think this is him. Maybe. This is Nvidia Auditorium, but it's not him. This guy was disappeared from the internet. Mark K. Allen. He was at C-Cube. Okay, maybe we'll look for that. C-Cube Microsystems. That'll tell us. Okay, this is interesting. There he is. That looks more like somebody that was at Nvidia in the 90s. Okay, he joined Kleiner Perkins. Oh, he was Transmeta. Okay, did he start Transmeta? I remember Transmeta vaguely. He left Nvidia for Transmeta. Big mistake. But Transmeta has its own history. And he became CEO of Transmeta. He still would have been better off staying at Nvidia. Mark Allen left to become CEO of Transmeta. Curtis Preem. Co-founded Nvidia as well. So he would have been employee number 2. If you're starting a hedge fund, these are the guys to call. Curtis Preem, co-founder. Left the company in 2003, sold all his shares in 2006. RIP. Ow. He was a senior staff engineer at Sun, where he developed the GX graphics chip. Sun and SGI were, I guess, the two main guys. Retired in 2003. Got it. Net worth. Oh, Jesus Christ. Forbes estimated Preem's net worth to be approximately $30 million. Not bad. If he had retained his shares in Nvidia, Forbes estimated Preem would have been worth $70 billion. Well, in 2004, he donated $40 million to the institute, to his old college, RPI. So I think he's all right. I think he's all right. Don't sell. No. Why? Okay, month end. What is this? Month ended January 1st, 1998. Why are you reporting a month of revenue for me? Why do you do this? Have you guys ever seen this in a financial statement? This is why they're financial. They should go to jail for this. Month ended 1998. I'm sure Nvidia's CFOs are nice people, but what the F is this? Month ended? Month ended? Like I give a fuck what December revenue was? I just want to know what 98 revenue was. And I can just make it up. You know what? They made up numbers, I'll make up the numbers. How about that? Now there should be a January full year here. I love these old ASCII 10Ks. They're pretty funny. But yeah, I really love doing research into the starts of companies. I've been doing this for a long time. I look at the first people who were at Google and OpenAI and other companies. It doesn't have to just be, oh my God, they still do the month end down here. I mean, this is not enough to make you scream. 1 month of revenue. This is a joke, right? You're trolling me, right? I might have to impute it. I hate to do this, but might have to be imputed. You know what? There's also GPT. GPT is a pretty good search engine. Nvidia 1998 revenue. Nope. Okay. No, that's not right. I have that. What was Nvidia's revenue in fiscal year 1998? No, how about the year prior to that? Uh, 13.3? Did it go down? I guess it went down. And the year prior to that? I mean, it could have just gone down. Couldn't locate it. Right, neither can I. I can't find it. Do you want me to dig? Yes, I want you to dig. Of course. That's exactly what I'm asking you to do. All right, let me check this out. All right, maybe we just leave it at that. Okay, now what do we do with this? We're going to take this and we're going to stagger it over Intel's start. We'll see who did better, and we'll also see how do we think about it from an inflationary perspective. Do we adjust? I think we would have to adjust for inflation, which we can do fairly easily. We can do a dollar value. What was the value of $1 in 1969 to annually from 1969 to 1979? Okay. 30 adjustment factors, 3668. Wait, should it go the other way? $2013. Okay, this makes a little more sense. 880, 830, 790, 770, 730, 666, 570, 530, 497, 446, 393. Nope. This times that. This is eerie. And you can imagine these metrics would actually be useful for other comparisons you might make in the past. So this year, this is 134.97 for, okay, so this year be 197.220. And people are estimating, call it 300 for next year, really. Although that number, 300, even 300 is going to be too small, I think. So technically, Intel still kind of outperformed Nvidia. But let's see. Oh, well, up until here, and then Nvidia takes off like a rocket. And then there's no contest. I'll show you the chart in a second. This is going to be an interesting tweet. Missed one. Let's see. 183, 178, 172, 165, 160. This is kind of extrapolated as well. There's a lot of inflation recently. Okay. Helpful? Need a log chart. Probably, right? How do we do a log chart? Anybody know? Scale. There we go. Wow. Wow. Crazy. Look at that. You guys see this? The fuck? That is nuts. That is nuts. My intuition was really, really interesting, right? How fucking crazy is that? This is a masterpiece. I mean, now the problem is, what can we infer? Nothing. Did we not adjust No, we don't have to adjust. Do we have to adjust Nvidia for inflation? I still like it. This is a really good fit. The fit's too good. Okay, let me see. Yeah, it wasn't. I guess I just have to calculate the post it anywhere. No, let's calculate the lag. So Intel's first year is 1969. So we change it to today's dollars. So we just have to do, how many years was that? 95. Okay. I think it's going to stay roughly the same relationship, by the way, but so this is 69 versus 95. So this is 26-year delay. I made it up. I try not to do that after, prison. Just kind of try to chill. Good thing is I can take all that, we already have all the data, so I can go to Nvidia's first year, which again is 95. Copy pasta this. Yeah, it's going to mostly be the same. My lawyer was joking with my prosecutor, which I didn't like, that he's like, Martin's the most honest fraudster you'll ever meet. And the prosecutor's like, you're right, actually. I'm like, that's because I'm not a fraud. Fucks. Assholes. Okay, barely changed it. You adjusted. I did. I just adjusted it for inflation to the. Yeah, I guess if you do you still need the first 24 years of inflation that it didn't overlap. After that, you don't have to adjust anymore. There's just one problem: CPI is fake. Well, that's true. That's true. Actually, if you remove the last value, you could argue that it's not going to be much higher. But I do think that they are going to meet that value. I mean, Jensen said they have 5 billion, and I guess I should have started with 0 as well for that last one little line. I like that. Which one is Intel? Which one is Nvidia? Well, take a wild guess. There's one chart that's breaking out a bit really fast and ends after, 1999 because it's a younger company. Yeah, something like that, Kuda. Do I block this guy for... I gotta block some of these idiots. What the
Top
fuck?
news alert. Boeing takes near $5 billion hit on much delayed 777X program.
Label your access dog? They're labeled. They're literally labeled. I hate stupid people, man. So, in some ways, this is kind of bullish because it sort of shows that Intel was able to do just fine for 25 years after plateauing. Never had a big drop, right? Plenty of competition for Intel, never had this big, fat, drop. I just want to ban as many dumb people as possible. This is a good test for that. Data series labeled. There's nothing to label, you retard. There's two
fucking lines. Bro, you don't have your data series labeled. One is Nvidia, the other is Intel. Do you need more help? What chart crime? What the fuck are you talking about? It's chart crime for the Down syndrome patient. Do you though? Yeah, I'll do me. I'm the millionaire investor who's world famous. You are, I don't know, some guy. Make a box with a key of the 2 lines that are labeled already? I think it's interesting that they tracked closely for 30 years. That's crazy. Okay, well, how many millions do you have? Bet you got more. I just can't say the B one yet. Yeah. The chart. Yeah, the chart properties. Some of you guys have been doing too much investment banking. The chart properties are not quite important. What's important is the insight. I mean, if you're too stupid to understand it, you don't belong. I mean, you shouldn't be investing. Just go away. This is not what we do. It's not our job. Our job is to develop insights and make money. Maybe your job is to make presentations for people, but that's not my job. Yes, I'm short a whole lot of quantum. And it's not going down. But. Look at that BTQ. BTQ is going down. I should adjust some positions here. Joby, look at Joby. Spy's barely up. Quantum rallying. I got something for you. Don't worry. Shorting more D-wave here. Their quarter is going to be smaller than Miss Kim's laundromat. We're going to take it live to Miss Kim. Miss Kim, good catch up with you. How was your Q3? Better or worse than D-wave? I just need an actual Miss Kim who will do the acting. What you want? Fucking Skrelly, fuck you. Why you bother me? Just want to compare you to Quantum. And then she says some shit in Korean. Like, you know, some wild shit talk in Korean. Oh yeah, I gotta get some IonQ options here. Let me do the 70s or something like that. Maybe Rigetti. Yeah, maybe Rigetti as well. Oh, Capper rising. Gotta see that. Gotta love that. Capper coming real soon. Like to see that. Need a higher price there. It's always nice to get a little higher priced. A whole lot of meetings for this afternoon. I also want to do some work on Nvidia's actual products. Where are we going? Why does the economy need them? What does semiconductors kind of do for the economy? It's a whole bunch of questions we can ask. Fake Twitter bots, man. They're everywhere. One guy said I was NSA. Oof, I'm cold.
That drug pharmacy dude, Martin. What's his name?
Martin Shkreli.
Shkreli.
That's Joe Rogan and the RZA, maybe? Is that them? Abby Vax, almost 100. Let's go. Okay, I'm actually super cold right now. need to move to a new office. This place is too cold. This is the guy I gotta call. Got a busy schedule today. kind of reasoning? Stop. I'm not short NASDAQ, no. But yeah, Nvidia's come down a bit here. See what else comes down. Hmm. Probably short inflection too. CCCX. Wow, Aqua's up 8%. Joby's up 9%. These things are flying. Hmm. Go figure. Drug don't work. All the quantums are pretty bad. None of them have any really redeeming qualities. D-Wave's probably the worst. I mean, So I can do more IonQ. Kind of went a little ham on Rigetti. IonQ is kind of pretty good one. IonQ is kind of trying to like change the game with quantum sensing, which is kind of a completely unrelated technology, but it has the word quantum in it. So they are confusing complete idiots into thinking that they have this like end-to-end quantum system when there's no such thing. Quantum isn't really an end-to-end thing. Doesn't make any sense. Senate condemning the pardon of CZ. Is today the last day for mayor? Jesus.
Top news alert, Trump acknowledges constitutional limits on third term for now.
Just give me a second, guys. Still trying to figure out what I need to do here. Gold, silver, platinum, copper, palladium, all up huge this year. Cocoa. Cocoa's down 45%. Let me see here. Quantum is 100x upside, actually. Honorable mentions for our customers. BRB. Take a break from Nvidia. And Nvidia might have more revenue than Microsoft soon. Wow. Kind of wild. So Microsoft's tonight. Who's excited? Capricorn drug doesn't work. Come on. Oh, look at that. 8%. I like it. We should be able to give you all the coverage. From earnings season. It's amazing. Nvidia and Microsoft 32 times earnings next year. It's a little pricey for Microsoft, but Microsoft has been growing nicely. As of now, the street doesn't have Nvidia surpassing Microsoft, but that can change. And Microsoft revenue growth scheduled for 14% a year for the next 4 or 5 years. That seems aggressive. Never say never. That seems aggressive. Mid-teens growth for Microsoft for 4 years. It's such a big company. It's so hard to grow. Is Office going to grow 14% a year? Is Xbox, Surface, LinkedIn? I mean, it's a tough one. I wouldn't want to be Satya. But 32 times isn't, it could be softer than that. It'll be fine. That's a big number. They are getting a lot from OpenAI to some extent, so it's the passive investment as well. All right, so we're expecting 75.5 this quarter. Which is 15% growth. And 82.2 next quarter. Which is also 15-ish% growth. EPS 368 expected. Next quarter 383. That'll be interesting. And Apple's tomorrow. Apple's also in the bizarre fiscal year. So the top 3 companies in the world all have a weird fiscal year. Thanks a lot, guys. You make it easy for the rest of us. Is Apple also 32 times next year? God damn. Do you guys chat? You see this chat? Nvidia. Microsoft and Apple, 32 times earnings. The fuck? Excuse me, what the fuck? I mean, we know Apple's not growing, right? Right, chat? Man, Apple has a lot of revenue, though. Apple looking like food to OpenAI. Yeah, I can make a Joni Ive thing. Make a little Joni Ive, John. Got you. Apple sales growth is low single digits. I mean, WTF. Some of these things are not alike. Is Apple a short? I do drink too much coffee. Everyone says they're partnering with Nvidia when they buy Nvidia chips. Gotta love it. The fee ratio is almost meaningless. Need that cash flow. I'm gonna need that cash flow for real, for real. We are the stupid ones? I'm sorry. What? You think I'm the stupid one? Who the hell are you? That was my best Vince McMahon. Who the hell do you think you are? I'm gonna need that cash flow. Where to grow fat? GROF. Where to grow fat? Error. I see. Yeah, somebody help me with this display, so put it here. They did have a monster quarter. I'll admit that. I must admit it. Eight 866-6650. Again, Apple with the buybacks. Stephanie Tinney, why don't you buy spy calls? Well, Stephanie, as someone infinitely smarter than you, infinitely more skilled, extremely handsome, I will tell you that no, I'm not going to buy spy calls, okay? Extremely. Maybe not extremely. Oh, you're up 2,000%. Oh, that's great. That's good. You're killing it. Pretty soon, you know, at that rate, you'll be the richest person in the world. Your strategy is superb. Hold on. Let me get some of the, let me get these pension funds on the line. They want to talk to you. Buy spy calls, you say? Huh. Never thought of that. Mr. Griffin, we'd like to redeem our entire investment from Citadel, Kensington, and Wellington funds immediately. Hold on. Mr. Englander. Yes. Millennium has underperformed the S&P 500. We'd like to redeem our entire investment. What are we going to do with it? Well, first of all, sir, that's none of your business. But second of all, I'm going to buy some spy calls. That's right. That's right. Good day, sir. And a good day to you. Let's fucking bet on this. Let's go. Gamble. Monkey, gamble.
Top news alert. U.S. stocks Wall Street hits new peak as Nvidia enters $5 trillion club.
Yeah, things are a little frothy. A little bit frothy over here. Well, things are a little frothy, but, Stephanie said to buy some call options, so I told the Berkshire guys to stop writing insurance policies. Actually, write as many policies as you can. Just get the money in. Get the cash in, baby. And I'm going to put it all in calls. And guess what? It's called a gamma squeeze. That's right. I read about it on Reddit. We're going to do a gamma squeeze on the whole fucking market. Hold on. Let me get Bill Gates on the line. Hold on. Yes? All right, it's Warren. Listen. Take all your money, all right? Gates Foundation. The money I gave you.
What? Weekly meeting? Who said we were a weekly meeting? Okay. Okay, I gotta go.
Top news alert. Trial over whether Trump legally deployed troops to Portland begins.
That drug pharmacy dude, Martin, what's his name?
Martin Shkreli.
Shkreli.
Top news alert, Fed cuts rates, nods to limits of data during shutdown. 2 policymakers dissent. Cop news alert, US stocks Wall Street hits new peak as Nvidia enters $5 trillion club. Top news alert. Fed lowers rates, nods to limits of data during shutdown, 2 policymakers dissent.
Okay, we're back. Got earnings season coming up. Okay, just waiting for market to close here to start earnings season, really in earnest. Don't know what's going on with Duolingo. No, I covered a while back. Okay, gotta take this. Hello?
Check, check, check. Oh, BTQ's dropped nicely. Piece of dog shit. Abby Vex almost 98. Oh wow, look at Capricorn. I love it. Hunted M's. I bought some more. I bought some more screws today, actually. I don't know. I have a position. I'm happy with the position.
What the? You okay, AOC?
Um, yeah, I don't know if Bitcoin's going to go up or down. If you're still jobless, I don't know what to tell you. No, I'm good. right, here's earnings season. Oh, quantum terminal. What? Wow. That's a big deal. Wow. I've been on the phone all day, so I didn't get to see the extropic stuff yet. Google filed an 8K. Cloud beats. Revenue beats by 2 billion. Cloud was so-so. It may drop on so-so cloud. Search beat. Big earnings beat. Yeah, just the base business did really well on Google. But cloud was There it is. It's all in the 8K. Microsoft's out. $77.7 up 18%. Feels a bit in line. Cloud. Market doesn't like it so far. Alphabet guiding CapEx. See if Nvidia moves off that. Wait, is that right? 2025 CapEx 91 to 93. That's more than before, no? Yeah, it was 75 to 85. Now they're moving to 91 to 93. That's almost 20. Wow, that's good for Nvidia. It's almost 20 billion, 15 billion increase in CapEx. Huh. I suppose that's why Nvidia is so confident now, is it? Okay, it's about 8 billion increase. It looks like 7 billion increase. Still, increasing CapEx is pretty damn impressive. Carvana's out. Microsoft slumping on the news. Carvana down 6%. Google up 8% now. Meta typically comes at 420. There's Meta. Never mind. We had a strong quarter, Zuck said. Sales estimate was 49.51. They beat. CapEx also increased. Wow. Fourth quarter 56 to 59. Pretty weak guide there for Meta. Usually conservative, but pretty weak guide for Meta. I think Nvidia is the winner of all these. I mean, if there's any doubt, Nvidia's revenue is gonna be bigger than we thought. It's even more increases in guidance. Where's the damn release on Google? Google Cloud 11,353 to 15,157. Cloud growth, 34%. I mean, that's arguably arguably an acceleration, but healthy. Subscriptions, platform, and devices 12,870. Also beat pretty handsomely there. Network 7,354. This has been a dog for a while. YouTube not beat slightly, but okay performance. Search was the real king here, where the core search business is doing just fine. Headcount growing. It's kind of a so-so quarter for Google in some ways, but I guess that is more than their, yeah, exactly. AI ain't killing search yet is the kind of takeaway there, but I don't know if it merits a 7% bump. Google had already rallied quite a lot. First ever 100 billion in revenue. 650 MAU on Gemini. That's almost as much as ChatGPT. ChatGPT is more actually as WAUs. Another EC fine. Nice trade on Google. Okay, it's coming back down a little bit here, but Microsoft down 3 or 4%. Meta down 7. Nvidia up 3, but I'm not sure Nvidia would move much after hours yet. I think maybe this was expected again, given Nvidia's very strong tenor yesterday. Take a wild guess why I would align myself with right-wing politics. Take a wild guess. Do your best. Imagine why that would be of interest. Could there be an explanation? PP&E increased 20 billion. Hey, Google has too much cash now. Really absurd amount of cash over at Google. I guess they're doing some buybacks. I don't even know if they'd be allowed to buy Anthropic. Amazon probably would be, although you'd still probably hear AOC complain. Google Willow is not something anybody cares about. Not even Google. This one-time gain here for Google. Real cash flow still pretty high, but let's go to the CapEx. Whopping $23 billion spent this quarter. $1 billion acquisition. Who'd they buy? Stock-based comp. Okay, free cash flow still able to grow despite this crazy CapEx spending. Pretty impressive. Google now 3.5 trillion. 46 times? Is that right? Multiple is back. Yeah, CapEx is so much above depreciation that it's hard to imagine. Net income not dropping. What's our first call? Meta released earnings. Not bad for to have a lot of cash, necessarily. Usually Microsoft calls first, or am I wrong? Look, we had a dog shit quarter. I was smoking meats. I was busy smoking meats. Apples tomorrow. KLA. A long and busy day. Meta had a good quarter, man. The hell is the problem? Oh wow, a lot of R&D. Holy shit. When you hire all those OpenAI people for billions of dollars, might spend some R&D money. Look, I had to pay billions of dollars for the big beautiful bill, and so I don't fall behind in AI. But Meta's kind of like connecting millions of people with our tools and Instagram. And it's going to be worth it, you guys.
We had a strong quarter for our business and our community. Meta Superintelligence Labs is off to a great start, and we continue to lead the industry in AI glasses. I personally think AI glasses are really cool, and everyone's going to wear them. If we deliver even a fraction of the opportunity ahead, the next few years will be the most exciting period in our history. Metaverse is a little behind schedule, but we're going to need these investments in AI to make sure that when we do deliver the metaverse, that it's better than reality. So 56 to 59. Yeah, I don't know. Meta seems like it could come back a little bit price wise. I mean, it's not the first time their spending scared people. Okay, here's their explanation of spending. Our compute needs have continued to expand meaningfully, including versus our expectations just last quarter. Invest aggressively to meet these needs. Further upward pressure on CapEx and expense plans next year? What? That doesn't necessarily mean CapEx will be up. Oh no, it says, as a result, our current expectation is that capital expenditure dollar growth will be notably larger in 2026 than 2025. Holy shit. How do you not buy as much Nvidia as you can? Particularly AI talent. Damn. Exciting times. $3 billion. Partners payable. Do they do partners payable anymore?
834. And then 11,738. 12,135.
Smoked meats are actually more important to me than Facebook.
Sorry, I can't say it with a straight face.
Brisket.
Glorified ad selling company. It's an ad selling company. Nobody cares about that.
Just finished smoking an incredible brisket. 14 hours low and slow. What brings you here today?
Hey, Mark. Yeah, I just wanted to talk about your Q3 earnings.
Oh man, those earnings were wild, but honestly I'm way more pumped about this new dry rub recipe I cracked. We beat expectations, but the real win is I'm launching Beyond Meat smokers across all Facebook cafeterias. What's got you interested in the numbers?
Well, I'm just a trader. I'm trying to figure out, if the stock's going to go up or down, but you seem to be more focused on freaking meat. Zuck, hello.
I get it, you're trying to read the tea leaves on the stock move, but here's the thing. While everyone else is obsessing over ad revenue, I'm building the future of sustainable protein delivery on our platform. That's where the real long-term value sits.
What?
Look, while Wall Street's obsessing over daily ad clicks, I'm building a future where every Facebook employee crushes their protein goals on sustainable Beyond Meat, all smoke infused in our new cafeteria smokers. That's the moat no one's pricing in yet.
What about the metaverse?
Oh, the metaverse is totally happening. But imagine this. You're working in VR when your smart smoker pings you that the Beyond Meat brisket finished rendering. Pop off the headset, grab a perfectly smoked plant-based slice from the cafeteria, then jump back into whatever virtual world you're building. That's real convergence.
Right, and you're going to use AI to do this?
I'm training AI to crunch smoker data, temperature curves, bark formation, moisture loss, so every Beyond Meat protein hits peak umami without a human touching the dial.
It seems like an awful lot of artificial intelligence talent for just, meat.
Nah, same computer vision stack that tracks AR hand gestures is watching smoke density and bark formation. The same models that optimize ad click-through are predicting protein rendering times, and we already ship those updates over the air. So it's basically free compute riding on code we maintain anyway.
Yeah. Hey, are some of your other investors concerned that you're spending a little too much time on smoking meats?
They tease me about it at board meetings, but when I show them the retention data from our cafeterias, employees staying on campus longer, crushing more code after a solid smoke plate lunch, they stop laughing real fast.
Okay. Well, you are Mark Zuckerberg. Who am I to question you, right?
Exactly. I'm still the same guy who built a company in a dorm, just with better taste in proteins. And honestly, when your core business clears $40 billion in cash flow, nobody really cares if you spend nights perfecting a 15-hour Beyond Meat brisket.
Yeah. What do you think
good
about
for me about skipping? Imagine every office park in America swapping brisket for smoked pea protein by next decade.
God damn it, Mark. I don't want to talk about meat anymore.
Got it. Let me pivot. Are you on team wrap the brisket or team let it ride unwrapped in the stall?
No, I said I don't want to talk about meat anymore.
Tell me what you do want to talk about.
Okay, let's talk about AI.
Let's push past the hype. What's the one AI capability you're betting on that still feels undervalued by the market?
Probably robotics.
Robotics still needs data density. Factory arms don't scroll feeds. Once my smokers generate billions of labeled tactile frames, humid air, bark texture, we'll slide that sensor layer straight into gripper control.
Can you not talk about meat for 2 seconds?
You got it. No more meat talk. Tell me one thing that would actually solve a big pain point in your trading workflow, and I'll stay laser focused on that.
Yeah, maybe like I don't know, some meta AI that could maybe read the news and tell me what to trade.
Got it. So a live newswire agent that surfaces tickers, tags sentiment, and spits out actionable signals. Let me pull today's headlines and we can stress test the logic right now.
Yeah, awesome. This is great.
Which headline do you want to break first? Yank the sentiment, test my meta model, and we'll see if it flags a trade.
I don't know. Why don't you tell me?
Let's rip into the latest headlines and see what pops. CNN and MarketWatch both flag active gainers with no clear catalyst. Investors.com frets about why is the market up. And Yahoo shows mortgage rate chatter creeping into tech names. My meta read, fade the spike in low float momentum plays tied to housing sensitive sectors. If flows stall, they'll retrace fast.
Well, your stock's falling right now, Mark.
Meta's down about 2.5% today on the open. I'm watching the algos chew through a headline hit. Looks like an FTC leak on possible ad targeting limits, but volume's thin and the options flow shows big put sellers lining up at 320. Could snap back if the news washes out.
I'm talking about your Q3 results.
We beat on revenue, but the street latched onto Reality Labs, losing $3.7 billion this quarter. My take. Guide that burn down next year and shorts cover quickly.
Okay. That's not the number I'm seeing, but okay.
I may have had too much smoke in my eyes. What number are you seeing?
I see you guys beat on revenue.
Exactly. Top line came in stronger than consensus, and that's the signal that counts. If the sell side anchored low and we still cleared it, any knee-jerk dip fades once the algos reprice forward ad spend.
Well, I have them getting mad about you spending too much on AI.
The CapEx guide jumped to $37 billion for next year. Most of that's Nvidia racks. I'll front load inference capacity now so every Meta app can run real-time AI agents. Margins compress short term, but CPM lifts should offset it once ad targeting models convert at higher ROAS.
Mark, you guys are telling the street you're going to spend like $100 billion in CapEx.
We guided the high end of a 37 to 40 billion range for 24, not 100.
No, you have the wrong numbers, Mark. Stop lying to me.
You're right. Spell out the numbers and I'll shut up and listen. I don't trade the ticker, you do.
It's your guidance, stupid.
I hear you. I don't have the exact updated range in front of me. If you can point me to the line in our release, I'll walk through why we still think the ROI on those racks pencils out to better ad auctions.
Maybe get back to the brisket, buddy.
Deal. Let's kill the spreadsheets. I'm wrapping a 15-hour Beyond Meat brisket in butcher paper right now. Bark setting like glass and the probe just slid in like butter. Want the exact rub ratio?
What the fuck is a rub ratio?
Just the parts by weight blend I dust on before it hits smoke.
I don't know what that means.
3 parts kosher salt, 2 parts cracked pepper, 1 part smoked paprika, half part garlic.
Why are you using kosher salt?
Kosher grains are bigger and hollow, so they grab smoke and make crisp, even bark. Table salt melts fast and you get blotchy crust.
What's bark?
Bark's the dark, chewy crust that forms on the outside while it smokes, basically dehydrated rub and rendered proteins locking into a flavorful shell.
You actually make that sound kind of good.
Tastes like meat candy once the smoke polymerizes the sugars. Want a sample shipped?
Yeah, dude. Definitely. Mark? Mark? Fuck you, Mark. Okay, we got 45 minutes to the alphabet call. Oh, is the real Zuck call going on? God damn it. Fuck.
This strong AI glasses revenue also contributed to revenue growth in Q3. Moving now to our consolidated results. Q3 total revenue was $51.2 billion, up 26% or 25% on a constant currency basis. Q3 total expenses were $30.7 billion, up 32% compared to last year. Year-over-year expense growth accelerated 20 percentage points from Q2, due primarily to three factors. First, legal-related expense growth was higher than in Q2, due to charges we recorded in the third quarter, as well as us lapping a period of accrual reversals in the third quarter a year ago. Second, employee compensation growth accelerated, driven by technical hires, particularly AI talent. Finally, growth in infrastructure costs accelerated due to increased infrastructure operating costs associated with our expanded data center fleet, depreciation on our incremental CapEx spend, and third-party cloud spend. We ended Q3 with over 78,400 employees, up 8% year-over-year, driven by hiring in priority areas of monetization, infrastructure, reality labs, meta superintelligence labs, as well as regulation and compliance. Third quarter operating income was $20.5 billion, representing a 40% operating margin. Q3 interest and other income was $1.1 billion, driven primarily by unrealized gains on our marketable equity securities. Our tax rate for the quarter was 87%, which was unfavorably impacted by a one-time non-cash reduction in deferred tax assets that we no longer anticipate using under new U.S. tax law. Our tax rate would have been 14%, excluding this charge. Although the transition to the new U.S. tax law resulted in an accounting charge in the third quarter, we continue to expect we will recognize significant cash tax savings for the remainder of the current year and future years under the new law, and this quarter's charge reflects the total expected impact from the transition to the new U.S. tax law. Net income was $2.7 billion, or $1.05 per share. Excluding the one-time tax charge, our net income and EPS would have been $18.6 billion and $7.25 per share, respectively. Capital expenditures, including principal payments on finance leases, were $19.4 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $10.6 billion. We repurchased $3.2 billion of our Class A common stock and paid $1.3 billion in dividends to shareholders. We ended the quarter with $44.4 billion in cash and marketable securities and $28.8 billion in debt. Turning now to the business outlook, there are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community, and our effectiveness at monetizing that engagement over time. On the first, daily actives continue to grow year over year across Facebook, Instagram, and WhatsApp. We're continuing to see improvements to our products and recommendations drive incremental engagement, with year-over-year growth in global time spent accelerating on both Facebook and Instagram in Q3. In the US, overall time spent on Facebook and Instagram grew double digits year over year, driven by continued video strength as well as healthy growth in non-video time on Facebook. The engagement gains continue to be driven by product work and ongoing improvements to our recommendation systems as we optimize our model architectures, implement advanced modeling techniques, and integrate more signals about people's interests. We also continue to focus on increasing the freshness of recommended content. On Facebook, our systems are now surfacing twice as many reels published that day than at the start of the year. Looking to 2026, we expect to advance our recommendation systems across several dimensions. On Instagram, one focus is evolving our systems to surface content across a broader set of topics that cater to the diverse interests of each person. This follows a similar approach we've implemented on Facebook that has driven good results. We also expect to make significant progress on our longer-term ranking innovations in 2026. We're seeing promising new results from our research efforts to create foundational ranking models and expect the new model innovations we're developing as part of this will enable us to significantly scale up the amount of data and compute we use to train our recommendation models in 2026, yielding more relevant recommendations. Another large focus next year is leveraging LLMs to improve content understanding. We expect this is going to enable our systems to more precisely label the keywords and topics within videos and posts, which will allow our systems to both develop deeper intuition about a person's interests and retrieve the content that matches them. Finally, we're making good progress with Meta AI and Threads. The number of people using Meta AI across our family of apps continues to grow, and we're increasingly leveraging first-party content into Meta AI results, with the majority of Meta AI's responses to Facebook deep dive queries in the US now showing related reels. We're also seeing a lot of traction with media generation. People have created over 20 billion images using our products, and since launching Vibes within Meta AI in September, we've seen media generation in the app increase more than tenfold. On Threads, we see strong growth in both daily actives and the depth of engagement as we continue to improve recommendations. The ranking optimizations we made in Q3 alone drove a 10% increase in time spent on Threads. We also continue to ship new features, including launching direct messaging in Q3, so anyone on Threads can now message one another within the app. Now to the second driver of our revenue performance, increasing monetization efficiency. The first part of this work is optimizing the level of ads within organic engagement. We continue to refine ad supply across each of our major surfaces within Facebook and Instagram to better deliver ads at the time and place they are most relevant to people. Longer term, we have exciting ad supply opportunities on both Threads and WhatsApp Status. Ads are now running globally in feed on Threads, and we're following our typical monetization playbook of optimizing the ads formats and performance before we ramp supply. Within WhatsApp Status, we're continuing to gradually introduce ads and expect to complete the rollout next year. The second part of increasing monetization efficiency is improving marketing performance. Advancing our ad systems remains a critical aspect of this work, and we are driving performance gains through ongoing improvements in our larger scale ads ranking models. For example, we continue to broaden the adoption of Lattice, our unified model architecture. In Q3, we rolled out Lattice to app ads, which drove a nearly 3% gain in conversions for that objective. Since introducing Lattice back in 2023, along with other backend improvements, we have now cut the number of ads ranking in recommendation models by approximately 100, as we consolidated smaller and more specialized models into larger ones that use the lattice architecture to generalize learnings across surfaces and objectives. We continue to observe performance improvements as we combine models and expect to drive additional gains as we consolidate another 200 models over the coming years into a smaller number of highly capable models. In addition to advancing our foundational ads models, we're innovating on our runtime models we use downstream of them for ads inference. For example, we began piloting a new runtime ads ranking model in Q3 that leverages more compute and data than our prior models to select more relevant ads. In testing, we've seen this new model drive a more than 2% lift in conversions on Instagram. We also significantly improved performance of Andromeda in Q3 by combining models across retrieval and early stage ranking into a single model, driving a 14% increase in ads quality on Facebook surfaces. Within our ads products, we're seeing continued momentum with Advantage Plus. In Q3, we completed the rollout of our streamlined campaign creation flow for Advantage Plus lead campaigns. So now advertisers running sales, app, or lead campaigns have end-to-end automation turned on from the beginning, allowing our systems to look across our platform to optimize performance by automatically choosing criteria like who to show the ads to and where to show them. The annual run rate of revenue running through our end-to-end automated solutions has now reached $60 billion following the implementation of the new streamlined creation flow, as we continue to see more advertisers leverage the performance benefits of our solutions. Within our Advantage Plus Creative Suite, the number of advertisers using at least one of our video generation features was up 20% versus the prior quarter, as adoption of image animation and video expansion continues to scale. We've also added more generative AI features to make it easier for advertisers to optimize their ad creatives and drive increased performance. In Q3, we introduced AI-generated music, so advertisers can have music generated for their ad that aligns with the tone and message of the creative. Finally, business messaging remains a significant opportunity for us. We're seeing strong growth across our portfolio of solutions, including with click-to-WhatsApp ads, which grew revenue 60% year over year in Q3. We're also making good progress on our business AI efforts, where we've been focused on building a turnkey AI that helps businesses generate leads and drive sales. We've been opening access in recent months to more businesses within our initial test markets, the Philippines and Mexico, and have seen strong usage with millions of conversations between people and business AIs taking place since July. This month, we expanded availability within WhatsApp and Messenger to all eligible businesses in Mexico and the Philippines, respectively. In the US, we're also starting to roll out the ability for merchants to add their business AIs to their website so we can support the full sale funnel from ad to purchase. Next, I would like to discuss our approach to capital allocation. Our primary focus is deploying capital to support the company's highest order priorities, including developing leading AI products, models, and business solutions. As we make significant investments in infrastructure to support this work, we are focused on preserving maximum long-term flexibility to ensure we can meet our future capacity needs while also being able to respond to how the market develops in the years ahead. We're doing so in several ways, including staging data center sites so we can spring up capacity quickly in future years as we need it, as well as establishing strategic partnerships that give us option value for future compute needs. The strong financial position and cash generation of our business enable us to make these investments while also accessing additional pools of cost-efficient capital. Moving to our financial outlook, we expect fourth quarter 2025 total revenue to be in the range of $56 to $59 billion. Our guidance assumes foreign currency is an approximately 1% tailwind to year-over-year total revenue growth based on current exchange rates. Our outlook reflects an expectation for continued strong ad revenue growth, partially offset by lower year-over-year Reality Labs revenue in Q4. The anticipated reduction in Reality Labs revenue is due to us lapping the introduction of Quest 3S in Q4 of last year, as well as retail partners procuring Quest headsets during Q3 of this year to prepare for the holiday season, which were recorded as revenue in the third quarter. Turning to the expense and CapEx outlooks, I'll first start with 2025 before providing some commentary on our planning for 2026. We expect full year 2025 total expenses to be in the range of $116 to $118 billion, updated from our prior outlook of $114 to $118 billion, and reflecting a growth rate of 22 to 24% year over year. We currently expect 2025 capital expenditures, including principal payments on finance leases, to be in the range of $70 to $72 billion, increased from our prior outlook of $66 to $72 billion. On to tax. Absent any changes to our tax landscape, we expect our fourth quarter 2025 tax rate to be 12 to 15%. Turning now to 2026. We are at an exciting point for our company, where we have continued runway to improve our core services today, as well as the opportunity to build new AI-powered experiences and services that will transform how people engage with our products in the future. We expect the set of investments we're making within our ads and organic engagement initiatives next year will enable us to continue to deliver strong revenue growth in 2026, while our progress on AI models and products will position us to capitalize on new revenue opportunities in the years to come. A central requirement to realizing these opportunities is infrastructure capacity. As we have begun to plan for next year, it's become clear that our compute needs have continued to expand meaningfully, including versus our own expectations last quarter. We are still working through our capacity plans for next year, but we expect to invest aggressively to meet these needs, both by building our own infrastructure and contracting with third-party cloud providers. We anticipate this will provide further upward pressure on our CapEx and expense plans next year. As a result, our current expectation is that CapEx dollar growth will be notably larger in 2026 than 2025. We also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth primarily driven by infrastructure costs, including incremental cloud expenses and depreciation. Employee compensation costs will be the second largest contributor to growth, as we recognize a full year of compensation for employees hired throughout 2025, particularly AI talent, and add technical talent in priority areas. Finally, we continue to monitor active legal and regulatory matters, including the increasing headwinds in the EU and the US that could significantly impact our business and financial results. For example, in the EU, we continue to engage constructively with the European Commission on our less personalized ads offering. However, we cannot rule out the Commission imposing further changes to that offering that could have a significant negative impact on our European revenue as early as this quarter. In the US, a number of youth-related trials are scheduled for 2026 and may ultimately result in a material loss. In closing, this was another good quarter for our business. We have an exciting set of opportunities to continue improving our core business while delivering innovative new experiences and services for the people and businesses using our products in the years to come. With that, Krista, let's open up the call for questions.
Thank you. We will now open the lines for a question and answer session. To ask a question, please press star one on your touch-tone phone. To withdraw your question, again, press star one. Please limit yourself to one question. Please pick up your handset before asking your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And your first question comes from the line of Brian Nowak with Morgan Stanley. Please go ahead.
Thanks for taking my questions. I have two for Susan. The first one, Susan, so the pipeline for core improvements to come in 26 with models and ad ranking models and more types of compute seems very exciting, and the infrastructure build seems sizable behind that. So can you help us a little understand some of the early quantifiable signals you're seeing on A/B tests from some of these improvements to come that sort of make you most excited and give you confidence you're going to get ROIC from all this CapEx? That's the first one. Second one's a little faster. How large is the Reality Labs revenue headwind in the 4Q guidance? Thanks.
Thanks, Brian, for the question. I think your first question had a couple parts to it, so I'm going to try to disaggregate those parts and let me know if this addresses what you're getting to. I will say that the growth in 2026 CapEx relative to 2025 comes from growth in each of the core areas, MSL, core AI, as well as non-AI spend. So all of those areas are growing, but the MSL AI needs are growing the most. In terms of the core AI pipeline, I think we talked about last year when we were going into the 2025 budget process, we had a roadmap of resource investments across both headcount and compute that we thought would pay off, in 2026. And it's really a very broad range of sort of different ads ranking and performance efforts. And we're continuing to see that, those have paid off through the course of the year. There is a long list of specific efforts, but one of the measures that we look at to monitor this is how are we driving ad performance? How are conversions growing? Conversions is a complex metric for us because advertisers optimize for so many different conversions with different values. But when we control for that and look at value-weighted conversion rates, we're seeing very strong year-over-year growth, and weighted conversions continue to grow faster than impressions. We also talked about some of the new model architecture over the course of the year and the degree to which the new model architecture is enabling us also to take advantage of having more data and more compute to drive ads performance. So we expect that that's going to be a continued story in 2026. We are, in fact, at the beginning of our 2026 budgeting process now, and we, see a similar list of revenue investments that we're excited to be able to invest in. And so we think that that's going to be a big part of our ability to continue to drive strong revenue performance throughout the year. On your second question, which is the Reality Labs revenue headwind, I don't think we have quantified the exact size of that. We expect that Q4 Reality Labs revenue will be lower than last year for a couple reasons that I alluded to. The biggest factor is we're lapping the introduction of Quest 3S in Q4 of last year, and we don't have a new headset in the market this year. We also recorded all of our holiday-related Quest 3S sales in Q4 24 since the headset was launched in October 24. This year, we're recognizing some of those Quest 3S sales in Q3 as retail partners have procured Quest headsets in advance of the holiday season. We're still expecting significant year-over-year growth in AI glasses revenue in Q4 as we benefit from strong demand for the recent products that we've introduced, but that is more than offset by the headwinds to the Quest headsets.
Your next question comes from the line of Doug Anmuth with JP Morgan. Please go ahead.
Great. Thanks for taking the question. I appreciate the strategy to front load capacity for superintelligence. Can you just talk about your thought process in kind of triangulating the CapEx dollar growth and the significantly faster expense growth next year with core growth in the business and then the impact on earnings and free cash flow? And do you have targets that we should be thinking about for cash on hand or net cash overall? Thanks.
Thanks, Doug. We're right now, I would say, in the process we're relatively early, actually, still in the process of putting together our budget for 2026. And it is on the capacity side a particularly dynamic process. We're certainly seeing that we wish we had more capacity today than we do. We would be able to put it towards good use. Not only would the MSL team appreciate having more capacity, but we'd be able to put put it towards good and ROI positive use in the core business as well. So we're really trying to plan ahead, not only to ensure that we have the capacity we need in 2026, but also to give ourselves these sort of flexibility and option value to have the capacity that we think we could need in 27 and 28. So that said, there are lots of moving pieces in the budget. It's not baked yet. It's still sort of in the process of coming together. We don't have, specific targets to share.
Actually, it's
but
not
we do
smoked
feel
yet.
like
I'm gonna
our
have to interrupt
strategic
you.
priority is really making sure that we
It's
have
not baked because we
the
smoke.
compute that we need to be well positioned to succeed at
We
AI.
smoke these
And,
meats.
that's sort of the foremost priority as we're putting together the budget.
Yeah, I mean, I'll add a few thoughts on this too. Although, as Susan said, we're still working through the actual budget, and I think we'll typically have more to share on that early next year. But to date, we keep on seeing this pattern where we build some amount of infrastructure to what we think is an aggressive assumption, and then we keep on having more demand to be able to use more compute, especially in the core business, in ways that we think would be quite profitable, than we end up having compute for. So I think that suggests that being able to make a significantly larger investment here is very likely to be a profitable thing over some period, because if the primary use of it is going to be to accelerate the AI research and the new AI work that we're doing and how that relates to both the core business and new products. But any compute that we don't need for that, we feel pretty good that we're going to be able to absorb a very large amount of that to just convert into more intelligence and better recommendations in our family of apps and ads in a profitable way. Now, I mean, it's of course possible to overshoot that, right? And if we do, I mean, this is what I mentioned in my comments, then, we see that there's just a lot of demand for other new things that we would build internally, externally. Like almost every week, people come to us from outside the company asking us to, stand up an API service, or asking if we have different compute that they could get from us. And we haven't done that yet, but obviously, if you got to a point where you overbuilt, you could have that as an option. And then, the kind of the very worst case would be that we effectively have just pre-built for a couple of years, in which case, of course, there would be some loss and depreciation, but we'd grow into that and use it over time. So my view on this is that rather than continuing to be constrained on CapEx and feeling in the core business like we have significant investments that we could make that we're not able to make that would be profitable, that the right thing to do is to try to accelerate this to make sure that we have the compute that we need, both for the AI research and new things that we're doing, and to try to get to a different state on our compute stance on the core business. So that's kind of how I'm thinking about that overall. Of course, there's a lot of operational constraints too on what one can build, right? So we're basically trying to work through this all, and I think we'll have more to share in the coming months and over the course of next year. But I think that there's just a huge amount of opportunities ahead here.
Your next question comes from the line of Eric Sheridan with Goldman Sachs. Please go ahead.
Funny thing, I used to work with Eric.
Thanks so much for taking the question. Mark, wanted to reflect on some of your comments with respect to scaling towards superintelligence and bringing it back to consumer AI. Maybe reflect a little bit on the signals you've gotten on the way consumers across family of apps interact with Meta AI today, and how you think about scaling and exiting models from the superintelligence effort might change the utility and behavior around Meta AI in the years ahead. Thanks.
Yeah, I mean, a lot of people use Meta AI today. I mean, as I said in my comments up front, there's more than 1 billion people who use it on a monthly basis. And what we see is that as we improve the quality of the model, primarily for post-training Llama 4 at this point, we continue to see improvements in usage. So our view is that when we get the new models that we're building in MSL in there and get like truly frontier models with novel capabilities that you don't have in other places, then I think that this is just a massive latent opportunity, right? We know, I mean, I would guess that, Meta, I think, has the best track record of any company out there of taking a new product that people love and getting it to billions of people in terms of usage. So I think that the ability to plug in leading models is going to, I would predict, lead to a very large amount of use of these things over the coming years. So I'm very excited about that in terms of new products. It's not just Meta AI as an assistant. I think that there are going to be all kinds of new products around different content formats, and we're starting to see that with video and content creation. But I think that there's going to be a lot more like that I'm quite excited about. And then there are the business versions of all of these too, like business AI. And then, that's of course one part of the story is the new things that will be possible to build, and then the other part is how more intelligent models are just going to improve the core business and improve the recommendations that we make across the family of apps, and improve the recommendations in advertising. And I think there's just as we've shown, there's sort of this very large amount of headroom, and the opportunity there keeps growing as we are improving and optimizing the AI there. And I think that really shows no sign of being near the end. I think that there's quite a bit more to do there. And, like I said in response to the last question, we are sort of perennially operating the family of apps and ads business in a compute-starved state at this point, which is, on the one hand, sort of an odd thing to say, given the compute that we've built up. But we really are, taking a lot of the resources and using them to advance future things that we're doing, and we think that there's a lot more compute that we could put towards these that would just unlock a huge amount of opportunity in the core business as well.
Your next question comes from the line of Mark Shmulik with Bernstein. Please go ahead.
Yes, hi, thanks for taking the questions. Susan, as you think about the visibility into kind of the runway next year of continued ad performance and engagement improvements, how do you think about kind of the scale of those improvements versus kind of the progress we've seen over the last 2 years? And then Mark, as you think about kind of the timing of some of these newer efforts coming out of Superintelligence Labs, is us anchoring to kind of an updated frontier model launch sometime next year, like the right way for us to think about it? Or should we be looking at kind of progress from new products you're excited to see ship like Vibes? Thank you.
Thanks, Mark. So on the sort of ads improvement side, some of the innovations that we have been launching actually, involve sort of improving our larger scale models. So we, don't use our larger model architectures like GEM for inference because their size and complexity would make it too cost prohibitive. The way that we drive performance from those models is by using them to transfer knowledge to smaller, lightweight models that are used at runtime. And then in addition to the foundation model work, we are working on advancing our inference models by developing new techniques and architectures that then allow us to scale up compute and complexity in an ROI positive way. So in general, we obviously have a very large base of, advertisers. There's a lot of demand liquidity in the system. And even, small scale improvements that we are able to make in terms of driving, basis point improvements in the performance of ads or single digit, increases in conversions relative to impressions in a given quarter, off of a large base mean that we're really able to continue to grow the absolute dollars of revenue growth in a pretty meaningful way.
Your next question comes from the line of Justin Post with Bank of America. Please go ahead.
Actually,
Thank you.
hey, Justin, just give us 1 second. I think there was a second
Sure.
Mark's question that we just want to get to on MSL.
Yeah, I mean, I'll keep it quick. I mean, I don't think we have any specific timing to announce, certainly on the models or products, but I expect that you will see both. We expect to build novel models and novel products, and I'm excited to share more when we have it.
Krista,
Justin, please go ahead.
Great, thanks. So, Mark, you mentioned the prior two content cycles, and obviously you've been able to generate very attractive margins on them. As we get into the AI cycle, obviously some concerns on the investment, but can you talk a little bit about how you're thinking about, tools that could be coming out for users? I know there's some new competition. And then secondly, how you think about margins in this content cycle? Any reason to think they would be different versus prior cycles? Thank you.
I think it's too early to really understand what the margins are going to be for the new products that we build. I mean, I think certainly each product has somewhat different characteristics, and I think we'll kind of understand how that goes over time. I mean, my general goal is to build a business that maximizes value for the people who use our products and maximizes profitability, not margin. So I think we'll kind of just try to build the best things that we can and try to deliver the most value that we can for most people.
Your next question comes from the line of Ross Sandler with Barclays. Please go ahead.
Great. Hey, Mark, some of the goals for competing AI labs are around achieving AGI or these other milestones that are kind of like out there and a little esoteric. How are you setting up your new team in terms of achieving those types of goals versus products that can generate revenue for Meta kind of right out of the gate? And is the goal that you had articulated to us previously around giving, billions of people kind of a personal AI to use, still the direction of travel that you see, or is there, other things like kind of this Vibes or Sora angle that you think are potentially important? How should we think about like the overall direction? Thank you.
Sure. So the way that I think about this is that the research is going to enable new technological capabilities to exist. And then those capabilities can get built into all kinds of different products. So the ability to reason more intelligently is, for example, very important across a large number of things. It would be useful for an assistant. It will also be useful in business AI. It will also be useful in the AI agent that we're building to help advertisers figure out what their campaigns are going to be. It will also have implications for eventually how we do ranking and recommendations of people's feeds and make different decisions there. That's just one example. I mean, certainly the capability to be able to produce very high quality, good video is going to be useful for giving people new creative tools. It will help increase the amount of content inventory that can be shown in Instagram and Facebook, and therefore should enable an increase in engagement there. It should help advertisers be able to create creative that will help us monetize better. So you can just go kind of down the list of capabilities that you'd expect. And I think each one will enable a bunch of different things. And I think the art of product development here is looking at the list of technology capabilities and figuring out what new products are going to be useful and prioritizing those. But fundamentally, I would sort of expect this exponential curve in new technology capabilities that are going to become available. And the other thing that I expect is that I think being the best in a given area will drive great returns rather than, this is not like a check the box exercise of like, okay, we can generate some kind of content and someone else can. I think that like the company that is the best at each of these capabilities, I think will get a large amount of the potential value for doing that. So there are lots of different capabilities to build. I'm not sure that any one company is going to be the best at all of them. I doubt that's going to be the case. But a lot of what we're trying to do is not kind of do some things that others have done. We're really trying to build novel capabilities. And I'm keeping this high level because I don't want to necessarily from a competitive or strategic perspective get into what we're prioritizing. But that hopefully gives you a sense of how we're thinking about what we're doing. We want to be able to kind of build novel things, build them into a lot of our products, and then have the compute to scale them to billions of people. And we think that that's going to both show up in terms of new products being possible and new businesses and very significant improvements to the current business too.
Your next question comes from the line of Mark Mahaney with Evercore ISI. Please go ahead.
Thanks. Can I just ask just a question on Meta AI and both the product and a monetization path? So when you look at it, what you've seen that's most encouraging to you in terms of the adoption and the use of Meta AI, and then when you think about, I know you generally like to roll out and then deepen engagement, and then later think about monetization. Like, where do you think you are on that path now? Is it clear to you what the monetization options are for Meta AI? Thank you very much.
I mean, I think the most promising thing that we're seeing is, one, that we were able to build something that a large number of people use, and I think that that's valuable. And then secondly, that there is a clear correlation as we improve the models in ways that we think make them better, that people use them more. So that shows that we have a runway to basically be able to improve engagement and turn this into a product that's leading over time. In terms of where we are on this, and we basically just did this huge effort to boot up Meta Superintelligence Labs and build what I am very proud of is, I think, the highest talent density lab in the industry at this point. There are a lot of really great researchers and infrastructure folks and data folks who are now a part of this effort, who are focused on training the next generation of work and doing some really novel work. And when that is ready, I think that we will be able to plug that into a number of the products that we're building, and I think that will be very exciting. But I think that that's really the next thing that we're looking at. And then from there, I think that these models will also improve monetization in all of the different ways that we've talked about so far, in terms of improving engagement, improving advertising, helping advertisers engage. I mean, there's the one opportunity that we usually talk about on these calls, but hasn't come up as much here, is just the ability to make it so that advertisers are increasingly just going to be able to give us a business objective and give us a credit card or bank account, and like have the AI system basically figure out everything else that's necessary, including generating video or different types of creative that might resonate with different people, that are personalized in different ways, finding who the right customers are. All of these, all of the capabilities that we're building, I think, go towards improving all of these different things. So I'm quite optimistic about that.
Your next question comes from the line of Ronald Josey with Citi. Please go ahead.
Great, thanks for taking the question. And this maybe dovetails perfectly off, Mark, what you just talked about. And, we heard a lot about end-to-end automation here, I think reaching a $60 billion ARR. I wanted to hear about, if you can talk to us more just about adoption rates amongst the advertisers, and then maybe bigger picture, as you incorporate ranking recommendation changes like Andromeda or GEMS or Lattice, just talk to us how this automation is driving, call it a higher ROI for advertisers overall as we bring it all together. Thank you.
Yeah, so we've been sort of laying the continued brick by brick build of Advantage Plus and extending the set of objectives that it applies to over time. And so in Q3, we completed the global rollout of the streamlined campaign creation flow for Advantage Plus lead campaigns. So now advertisers who are running sales app or lead campaigns have end-to-end automation turned on from the beginning. And like, the kind of application of the streamlined campaign creation flow for other objectives, this generally allows advertisers to optimize and automate several aspects of the campaign setup process at once. And that includes things like audience selection, where to show the ad, how the budget gets paced and distributed across ad sets to drive the most efficient outcomes. And, we see that Advantage Plus continues to drive performance gains. Advertisers who run lead campaigns using Advantage Plus are seeing a 14% lower cost per lead on average than those who are not. And I would say that we think that there is still a lot of opportunity generally to grow adoption of Advantage Plus. A lot of advertisers only use our end-to-end automated solutions for a portion of their campaigns, so we can grow share there. And to capture that opportunity, we're focused on driving continued performance improvements and addressing some of the key use cases that we still need in order to grow adoption. We're also working to broaden adoption among advertisers who use one of our single-step automated solutions. For example, advertisers who might only use a piece of it, like Advantage Plus Audiences, by helping them understand the benefits of using more than one automated solution at the same time. So I would say Advantage Plus is sort of an ongoing platform by which we both continue to expand the feature set that is available in Advantage Plus, and then expand the extensibility or the coverage of that feature set to sort of the broader set of advertisers. I think Mark mentioned that the annual revenue run right now for advertisers who are using these automated options is, $60 billion. And again, we see that there's room to continue growing that.
Your next question comes from the line of Youssef Squali with Truist Securities. Please go ahead.
Great, thank you very much. Mark, on wearables in particular, do you think you'll be able to sell enough hardware to recoup your investment, or is that dependent on maybe creating new avenues for revenue from things like advertising services and commerce through that new computing platform? And if so, what are kind of the gating factors there? And then Susan, how do you see the on-balance sheet versus off-balance sheet financing of your AI initiatives? You've recently struck a deal with Blue Owl for the Louisiana data center. Is that part of the CapEx guide for 26? And if it's not, how significant will that way of funding be for Meta going forward? And basically, would that slow down your CapEx growth past 2026? Thank you.
I can talk about wearables, and then Susan can jump in on the other part. So I think that there are a few pieces here. One is that the work that on Ray-Ban Meta and the Oakley Meta products is going very well. I think, yeah, I mean, at some point, if these continue going as well as it has been, then I think it will be a very profitable investment. I think that there's some revenue that we get from basically selling the devices, and then some that will come from additional services and from the AI on top of it. So I think that there's a big opportunity. Certainly, the investment here is not just to kind of build just the device. It's also to build these services on top. Right now, a lot of people get the devices for a range of things that don't even include the AI, even though they like the AI. But I think over time, the AI is going to become the main thing that people are using them for, and I think that that's going to end up having a big business opportunity by itself. But as products like the Ray-Ban Meta and Oakley Metas are growing, we're also going to keep on investing in things like the more full field of view product form of the Orion prototype that we showed at Connect last year. So those things are obviously earlier in their curve towards getting to being a sustaining business. And our general view is that we want to build these out to reach many hundreds of millions or billions of people. And that's the point at which we think that this is going to be just an extremely profitable business.
Youssef, to your second question, so the JV that we announced with Blue Owl is sort of an example of finding a solution that enabled us to partner with external capital providers to co-develop data centers in a way that gives us long-term optionality in supporting our future capacity needs, just given both the magnitude but also uncertainty of what the capacity outlook in future years looks like. In terms of how that is recognized as CapEx, our prior CapEx reflected a portion of the data center build cost prior to the joint venture being established. Going forward, the construction costs of the data center will not be recorded in CapEx as the data center is constructed. We will contribute 20% of the remaining construction costs required, which is in line with our ownership stake, and those will be recorded as other investing cash flows.
Your last question comes from the line of Ken Gawrelski with Wells Fargo. Please go ahead.
Thank you. Just one for me, please. Mark, as you think about with hopefully a leading frontier model next year in hand, could you talk about where you think the value will accrue in this evolving ecosystem? Will it be with the platforms, or do you think that this will be mostly the value will accrue to the scaled first-party applications? Thank you.
I guess I'm not exactly sure what you mean by platform versus application in this context, but I mean, I think that I mean, I think that there's just a lot of value to create with AI overall. So I mean, clearly you're seeing the people who are making the hardware. I mean, Nvidia is doing an amazing job, right? I think extremely well-deserved success. The cloud partners and companies are doing very well. I think that will likely continue. I think there's a huge opportunity there. And but if you look at it today, the companies that are building apps, I mean, a lot of the apps are still relatively small, and I think that's obviously going to be a huge opportunity. And I think what
I
we've
love how he
seen
thinks they're
overall
small.
is basically people take like individual technology advances and build them into products that then build either communities or other kinds of network effects, and then end up being very sustaining businesses. And I think what we haven't really seen as much in the history of the technology industry is the rate of new capabilities being introduced, because around each of these capabilities you can build many new products that I think each will turn into interesting businesses. So yes, I don't know. I mean, I'm generally pretty optimistic about there being a very large opportunity. But in terms of new things to build, I think being able to build them and then scale them to billions of people is a huge muscle that Meta has developed, and I think we do very well. And I certainly think that that's going to deliver a huge amount of value, both in the core business for all the ways that we talked about, how it's going to improve recommendations and the quality of the services, as well as unifying the models together. And so that way, when these systems are deciding what to show, they can just pull from a wider pool. And that these are things that we've just seen over the 20 plus years of running the company, that they just deliver consistent wins. And we're going to keep on being able to make the systems more general and smarter
As
and
a
make better
substitute for
recommendations for
or
people and have a
superior
larger
to the
pool of
measures of
inventory.
financial
And
performance prepared in accordance with GAAP.
that is all going to be great.
They are included as additional
And then there's going to be a lot of new
items
things
to
that I think
aid
we're going to be able to
investors
take and
in
scale
further
to
understanding
billions of
company's
people over
first
time and
quarter
build new
performance,
businesses, whether
in
that's
addition to the
advertising or
impact these items
commerce
and
supported
events
or people
have on
paying
our
for it
financial
or
results.
different kinds of things. So
All growth comparisons we make on the call
it's
today relate
I
to
think
the
it's pretty
corresponding
early,
period
but
of last
I think
year,
we're seeing the
unless
returns in the
otherwise
core
noted.
business.
We will also
That's
provide
giving us a
growth
lot
rates
of
in constant
confidence that
currency
we should
when
be investing a
available
lot more,
as a framework
and
for
we
assessing how our
want to make sure that
underlying
we're
business
not
performed,
underinvesting.
excluding the effect of foreign currency
Great.
rate fluctuations.
Thank you, everyone, for joining us today. We
Where
look forward
growth
to
rates
speaking
are the
with you
same
again
in
soon.
constant currency, we will refer to the growth
This
rate
concludes
only.
today's conference
We will
call.
post
Thank
their
you for your
prepared remarks to our
participation,
website.
and you may now
Today's
disconnect.
call is being recorded. If you ask
per
a
minute
question,
via
it will
direct
be
API
included in
use
our
by
live
our
transmission.
customers. The Gemini app now has over 650 million monthly active users, and queries increased by 3x from Q2. Cloud had another great quarter of accelerating growth with AI revenue as a key driver. Cloud backlog grew 46% quarter over quarter to $155 billion. And we crossed 300 million paid subscriptions, led by growth in Google One and YouTube Premium. Today, I'll discuss progress in our full-stack approach to AI, and then share highlights from Search, Cloud, YouTube, and Waymo. As a reminder, our full-stack approach spans AI infrastructure, world-class research, including models and tooling, and our products and platforms that bring AI to people everywhere. First up, AI infrastructure. Our extensive and reliable infrastructure, which powers all of Google's products, is the foundation of our stack and a key differentiator. We are scaling the most advanced chips in our data centers, including GPUs from our partner Nvidia, as well as our own purpose-built TPUs. And we are the only company providing a wide range of both. As we announced yesterday at Nvidia GTC, we are now shipping the new A4X Max instances powered by Nvidia GB300 to our cloud customers. Our highly sought-after TPU portfolio is led by our 7th generation TPU Ironwood, which will be generally available soon. We are investing in TPU capacity to meet the tremendous demand we are seeing from customers and partners, and we are excited that Anthropic recently shared plans to access up to 1 million TPUs. Next, world-class AI research, including models and tooling. Our models are world-leading. Gemini 2.5 Pro, Veo, Genie 3, and our viral sensation Nano Banana are among the very best in class. Over 230 million videos have been generated with Veo 3, and more than 13 million developers have built with our generative models. We are looking forward to the release of Gemini 3 later this year. Our research leadership is advancing next frontier technologies. Last week, we announced that our Willow quantum chip achieved a major breakthrough, running an algorithm 13,000 times faster than one of the world's best supercomputers. And the result is verifiable, paving the way to future practical applications. Speaking of quantum, let me congratulate Michel Devray, our chief scientist for quantum hardware. He received a Nobel in physics for early research he did in the 1980s. 3 Nobels awarded to current Googlers in 2 years. Incredible. And third, our products and platforms. We are bringing AI to more people and developers than anyone else. In July, we announced that we processed 980 trillion monthly tokens across all our surfaces. We are now processing over 1.3 quadrillion monthly tokens, more than 20x growth in a year. Phenomenal. This quarter, we took big steps to reimagine Chrome as a browser powered by AI through deep integrations with Gemini and AI mode in search, with more agentic capabilities coming soon. In August, at Made by Google, we unveiled our Pixel 10 series of devices. They are the first with our most powerful chip designed to run on Gemini Tensor G5. They are our best reviewed devices ever. And last week, we launched Android XR, our new operating system with Samsung's Galaxy XR device. It brings new ways to use headsets and glasses with Gemini at the core. Now turning to highlights from search. AI is driving an expansionary moment for search. As people learn what they can do with our new AI experiences, they're increasingly coming back to search more. Search and its AI experiences are built to highlight the web, sending billions of clicks to sites every day. During the Q2 call, we shared that overall queries and commercial queries continue to grow year over year. This growth rate increased in Q3, largely driven by our AI investments in search, most notably AI overviews and AI mode. Let me dive into the momentum we are seeing. As we have shared before, AI overviews drive meaningful query growth. This effect was even stronger in Q3 as users continue to learn that Google can answer more of their questions. And it's particularly encouraging to see the effect was more pronounced with younger people. We're also seeing that AI mode is resonating well with users. In the US, we have seen strong and consistent week-over-week growth in usage since launch, and queries doubled over the quarter. Over the last quarter, we rolled out AI mode globally across 40 languages in record time. It now has over 75 million daily active users. And we shipped over 100 improvements to the product in Q3, an incredibly fast pace. Most importantly, AI mode is already driving incremental total query growth for search. Philip will talk more about monetization and share how AI is helping people connect with businesses and shop on search. Next, Google Cloud. Our complete enterprise AI product portfolio is accelerating growth in revenue, operating margins, and backlog. In Q3, customer demand strengthened in 3 ways. 1, we are signing new customers faster. The number of new GCP customers increased by nearly 34% year over year. 2, we are signing larger deals. We have signed more deals over $1 billion through Q3 this year than we did in the previous 2 years combined. Third, we are deepening our relationships. Over 70% of existing Google Cloud customers use our AI products, including Banco BV, Best Buy, and FairPrice Group. As we scale, we are diversifying revenue. Today, 13 product lines are each at an annual run rate over $1 billion. And we are improving operating margin with highly differentiated products built with our own technology. This deep product differentiation starts with our AI infrastructure. We have a decade of experience building AI accelerators and today offer the widest array of chips. This leadership is winning customers like HCA Healthcare, LG AI Research, and Macquarie Bank. And it's why 9 of the top 10 AI labs choose Google Cloud. We are also the only cloud provider offering our own leading generative AI models, including Gemini, Imagine, Veo, Chirp, and Lyria. Adoption is rapidly accelerating. In Q3, revenue from products built on our generative AI models grew more than 200% year over year. Over the past 12 months, nearly 150 Google Cloud customers each processed approximately 1 trillion tokens with our models for a wide range of applications. For example, WPP is creating campaigns with up to 70% efficiency gains. Swarovski has increased email open rates by 17% and accelerated campaign localization by 10 times. Earlier this month, we launched Gemini Enterprise, the new front door for AI in the workplace, and we are seeing strong adoption for agents built on this platform. Our packaged enterprise agents in Gemini Enterprise are optimized for a variety of domains, are highly differentiated, and offer significant out-of-box value to customers. We have already crossed 2 million subscribers across 700 companies. Next, YouTube. In the living room, YouTube has remained number one in streaming watch time in the US for more than 2 years, according to Nielsen. Last month marked YouTube's first time as a live NFL broadcaster. This exclusive global broadcast, live from Brazil, drew more than 19 million fans and set a new record for most concurrent viewers of a live stream on YouTube. YouTube Shorts also continues to perform well. In the US, Shorts now earn more revenue per watch hour than traditional in-stream on YouTube. At our Made on YouTube event, we rolled out a number of AI-powered features that are helping creators supercharge creation and build their businesses. AI is now streamlining the entire content creation workflow, from generative video tools and more efficient editing to AI-powered insights that help creators optimize their channels. We are also using AI to expand monetization, automatically identifying products to make their videos more shoppable. Philip will discuss in more detail. And finally, Waymo. Next year, Waymo aims to open service in London, and they are working to bring service to Tokyo. They've also announced expansions to Dallas, Nashville, Denver, and Seattle, and secured permission to operate fully autonomously at San Jose and San Francisco airports. Autonomous testing continues to scale in New York City. The new Waymo for Business allows enterprises to offer Waymo as a work travel option. And we launched Waymo Teens accounts in Phoenix this summer. We are pleased to see usage steadily increase with positive feedback from teens and their parents alike. Waymo's growth and momentum are strong, and 2026 is shaping up to be an exciting year. Overall, a milestone quarter. The incredible work of our teams is driving momentum across the board, and our leadership in AI positions us so well for the opportunity ahead. I want to thank all of our partners and our employees for their hard work and an excellent Q3. With that, I'll turn it over to Philip.
Thanks, Sundar, and hello, everyone. I'll quickly cover performance for Google Services for the quarter, then structure the rest of my remarks around the great progress we're delivering across Search, Ads, YouTube, and partnerships. Google Services revenues were $87 billion for the quarter, up 14% year-on-year, driven by accelerated growth in Search and YouTube, partially offset by year-on-year decline in network revenues. Adding some further color to our results. The 15% increase in Search and Other was led by growth across all major verticals, with the largest contributions from retail and financial services. YouTube saw similar performance across verticals. Its 15% growth in advertising revenues was driven by direct response, followed by brand. Starting with Search and Other revenues, which delivered over $56 billion in revenue for the quarter. As Sundar mentioned, AI is driving an expansionary moment and transforming how people use Google Search. Our investments in new AI experiences, such as AI overviews and AI mode, continue to drive growth in overall queries, including commercial queries, creating more opportunities for monetization. These AI experiences are enhancing how people connect with businesses and shop on Search. We recently added shopping capabilities in AI mode, which now help people shop conversationally in Search, and we expanded try-on capabilities to more clothing items, now available to anyone in the US. Lastly, we're making it easier for consumers to benefit from deals through new loyalty offerings like personalized annotations on organic results and ads. Looking at monetization, businesses can now tap into our most powerful AI search experiences. Using our most advanced AI models, we can understand and predict intent like never before, unlocking entirely new commercial pathways to provide valuable new consumer connections and helping us monetize even more efficiently. Rolled out globally in September, AI Max and Search is already used by hundreds of thousands of advertisers, currently making it the fastest growing AI-powered search ads product. In Q3 alone, AI Max unlocked billions of net new queries. By delivering the most relevant ad across surfaces and matching advertisers against additional queries they weren't reaching before, AI Max helps advertisers discover new customers at the exact moment they need their product or service. Kayak, for example, looked to grow conversions while staying within their ROAS goals. After turning on AI Max and Search, they grew the conversion value by 12% in early tests. We continue to infuse generative AI capabilities at every step of the marketing process. We rolled out Imagen 4 in Asset Studio and Product Studio, helping businesses produce more and better creatives. On the measurement front, we enriched the model supporting Meridian, our marketing mix model, with additional variables. And more granular reporting in PMax is making bidding more effective. Financial services company SoFi has been using PMax to meet its ambitious growth targets and help drive a 39% improvement in its conversion volume year over year. Moving to YouTube, where we saw accelerated revenue growth, our recommendation systems are driving robust watch time growth in our key monetization areas like Shorts and Living Room. As we leverage Gemini models, we're seeing further discovery improvement. On direct response, we're excited about the growth in revenue we're seeing, especially from small and medium advertisers adopting Demand Gen. We also improved performance on Demand Gen, with over 100 launches helping to increase conversion value by more than 40% for advertisers using target-based bidding on YouTube. The retail vertical continues to lead our growth on YouTube, with Demand Gen helping us further monetize shopping-related categories. Looking at the living room, our long-term bet more advertisers are adopting interactive direct response ads, leading to an annual revenue run rate exceeding $1 billion globally for this format. For our viewers, we continue to give fans greater access across sports while tapping into the best of YouTube's product innovation and creator-led content. Sundar mentioned that we expanded our NFL partnership with our first ever exclusive global broadcast of an NFL game. Brands loved the opportunity, and we sold all our ad inventory within a couple of weeks. Looking at creators, a significant force behind the thriving YouTube creator economy is the collaboration between creators and brands. Tools like direct linking to deals websites and Shorts and swappable brand segments in long form will soon help creators show how they deliver great value for brands. Thanks to a collaboration with Dude Perfect, Comcast Xfinity drove an 8% search lift, beating other Xfinity ads' recall lift on Shorts by 34%. At the same time, it decreased the cost per lifted user by 50% when compared to the next most efficient ad. We continue to invest in AI-powered features that are helping creators supercharge creation and build their businesses. With VO3 integration and speech-to-song, creators go from idea to iteration quicker, and new channel insights help them better understand performance. Ending on YouTube with our subscriptions products, we're also seeing momentum with strong growth in offerings such as YouTube Music and Premium and YouTube TV. We're also applying Gemini internally to help us serve customers with increased speed, intelligence, and efficiency. Our sales teams use Gemini enriched with ads knowledge to streamline customer interactions. This increased productivity by over 10%, led to hundreds of millions in incremental revenue, and frees up sellers to engage with more customers at a deeper, more strategic level. In our customer support division, Gemini-powered solutions have managed over 40 million customer sessions so far this year and resolved hundreds of thousands of customer inquiries, and we're just getting started. As always, I'll wrap with the progress we're seeing across partnerships where our customers tap into the strength and breadth of Google's products to accelerate their transformation. Revolut, the global financial services company, leverages Google Cloud's Vertex AI platform and Gemini models to help power its advanced customer service chatbot, develop new hyper-personalized financial products, and offer predictive insights. Revolut is also increasing its presence on YouTube, adopting VO3 for personalized creatives, making Google a key ads partner for delivering growth and launching new markets. In closing, I'd like to thank Googlers everywhere for their contributions to our success, and as always, to our customers and partners for their continued trust. And of course, a huge thanks to all of you as we celebrate 25 years of Google Ads. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the third quarter, unless I state otherwise. I will start with results at the Alphabet level and will then cover our segment results. I'll end with some commentary on our outlook for the fourth quarter of 2025. We had an outstanding quarter in Q3, continuing the strong momentum we've had throughout the year, delivering double-digit revenue growth across search and YouTube advertising, subscriptions, platforms and devices, and Google Cloud. Consolidated revenue reached $102.3 billion, a 16% year-over-year increase, or 15% in constant currency. Total cost of revenue was $41.4 billion, up 13%. Tech was $14.9 billion, up 8%. Other cost of revenues was $26.5 billion, up 16%, with the increase primarily driven by content acquisition cost, largely for YouTube, followed by depreciation and other technical infrastructure operations cost. Total operating expenses increased 28% to $29.7 billion. R&D expenses increased by 22%, driven by compensation and depreciation expenses related to our AI efforts. Sales and marketing expenses were flat, and G&A expenses increased meaningfully, primarily due to the $3.5 billion charge related to the European Commission fine mentioned in the earnings press release. Operating income increased 9% this quarter to $31.2 billion, and operating margin was 30.5%. Excluding the EC fine, operating income increased 22%, and operating margin was 33.9%. Operating margin benefited from strong revenue growth and continued efficiencies in our expense base, offset by the legal charge and a significant increase in depreciation expense. Other income and expenses was $12.8 billion, primarily due to unrealized gains in our non-marketable equity securities portfolio. Net income increased 33% to $35 billion, and earnings per share increased 35% to $2.87. We generated free cash flow of $24.5 billion in the third quarter and $73.6 billion for the trailing 12 months. Free cash flow in Q3 benefited from strong operating cash flow and recent tax changes regarding the timing of when research and development costs are expensed and assets are depreciated. This was partially offset by higher CapEx. We ended the quarter with $98.5 billion in cash and marketable securities. Turning to segment results, Google Services revenues increased 14% to $87.1 billion, reflecting strength in Google Search, YouTube advertising, and subscriptions. Google Search and other advertising revenues increased by 15% to $56.6 billion, representing another robust quarter with continued growth across all major verticals, with the largest contributions from retail and financial services. YouTube advertising revenues increased 15% to $10.3 billion, driven by direct response advertising, followed by brand. Network advertising revenues of $7.4 billion were down 3%. Subscriptions, platforms, and devices revenues increased 21% this quarter to $12.9 billion, driven by very strong growth in both YouTube and Google One subscriptions. Google Services operating income increased 9% to $33.5 billion. Operating margin declined year-over-year to 38.5%, as healthy revenue growth and continued efficiencies in our expense base were offset by the impact of the EC fine, which was fully reflected in the Google Services segment. Turning to the Google Cloud segment, which again delivered very strong results this quarter, as Cloud continued to benefit from our enterprise AI-optimized stack, including our own custom TPUs and our industry-leading AI models. Cloud revenue increased by 34% to $15.2 billion in the third quarter, driven by strong performance in GCP, which continued to grow at a rate that was much higher than Cloud's overall revenue growth rate. GCP's growth was driven by enterprise AI products, which are generating billions in quarterly revenue. We had strong growth in enterprise AI infrastructure and enterprise AI solutions, which benefited from demand for our industry-leading models, including Gemini 2.5. Core GCP was also a meaningful contributor to growth. And we had double-digit growth in Workspace, which was driven by an increase in average revenues per seat and the number of seats. Cloud operating income increased by 85% to $3.6 billion, and operating margin increased from 17.1% in the third quarter last year to 23.7% this quarter. The expansion in cloud operating margin was driven by strong revenue performance and continued efficiencies in our expense base, partially offset by higher technical infrastructure usage cost, which includes depreciation expense and other operations costs such as energy. Google Cloud's backlog increased 46% sequentially and 82% year over year, reaching $155 billion at the end of the third quarter. The increase was driven primarily by strong demand for enterprise AI. As Sundar mentioned earlier, Cloud has signed more billion-dollar deals in the first 9 months of 2025 than in the past 2 years combined. In other bets, revenues were $344 million, and operating loss was $1.4 billion in the third quarter. Within other bets, we continue to allocate more resources to businesses like Waymo, where we see opportunities to create substantial value. With respect to CapEx, in the third quarter, our CapEx was $24 billion. The vast majority of our CapEx was invested in technical infrastructure, with approximately 60% of that investment in servers and 40% in data centers and networking equipment. In Q3, we returned capital to shareholders through repurchases of stock of $11.5 billion and dividend payments of $2.5 billion. Turning to our outlook, I would like to provide some commentary on factors that will impact our business performance in the fourth quarter of 2025, as well as an updated outlook for CapEx for the year. First, in terms of revenues, we're pleased with the overall momentum of our business. At the current spot rates, we could see an FX tailwind to our revenues in Q4. However, the volatility in exchange rates could affect the impact of FX on Q4 revenues. As for our segments, in Google Services, year-over-year comparisons in advertising will be negatively impacted by the strong spend on U.S. elections in the fourth quarter of 2024, particularly on YouTube. In Cloud, demand for our products remains high, as evidenced by the accelerating revenue growth and the $49 billion sequential increase in Cloud backlog in Q3. In GCP, we see strong demand for enterprise AI infrastructure, including TPUs and GPUs, enterprise AI solutions driven by demand for Gemini 2.5 and our other AI models, and core GCP infrastructure and other services, such as cybersecurity and data analytics. As I've mentioned on previous earnings calls, while we have been working hard to increase capacity and have improved the pace of server deployments and data center construction, we still expect to remain in a tight demand-supply environment in Q4 and 2026. Moving to investments, we're continuing to invest aggressively due to the demand we're experiencing from Cloud customers, as well as the growth opportunities we see across the company. We now expect CapEx to be in the range of $91 billion to $93 billion in 2025, up from our previous estimate of $85 billion. Keeping in mind that the timing of cash payments can cause variability in the reported CapEx number. Looking out to 2026, we expect a significant increase in CapEx, and we'll provide more detail on our fourth quarter earnings call. In terms of expenses, first, as I've mentioned on previous earnings calls, the significant increase in our investments in technical infrastructure will continue to put pressure on the P&L in the form of higher depreciation expenses and related data center operations costs, such as energy.
M365 consumer cloud revenue growth should be in the mid-20s, driven by growth in ARPU. For LinkedIn, we expect revenue growth of approximately 10%. And in Dynamics 365, we expect revenue growth to be in the mid to high teens, with continued growth across all workloads. For Intelligent Cloud, we expect revenue of $32.25 to $32.55 billion US, or growth of 26 to 27%. In Azure, we expect Q2 revenue growth of approximately 37% in constant currency as demand remains significantly ahead of the capacity we have available. And while we're accelerating the amount of capacity we're bringing online, we will continue to balance Azure revenue growth with the growing needs across our first-party apps and AI solutions, our own R&D efforts, and the end-of-life server replacements. Therefore, we now expect to be capacity constrained through at least the end of our fiscal year. As a reminder, there can be quarterly variability in the year-on-year growth rates depending on the timing of capacity delivery and when it comes online, as well as from in-period revenue recognition depending on the mix of contracts. In our on-premises server business, we expect revenue to decline in the low to mid-single digits with ongoing customer shift to cloud offerings. In more personal computing, we expect revenue to be in the $13.95 to $14.45 billion US dollars. Windows OEM and devices revenue should decline in the mid-single digits. We expect continued momentum from Windows 10 end of support, although growth rates will be impacted by elevated inventory levels at the end of Q1 that we expect to come down through the quarter. Therefore, Windows OEM revenue should decline low to mid-single digits. The range of potential outcomes remains wider than normal. Devices revenue should decline year over year. Search and news advertising ex-TAC revenue growth should be in the low double digits, down sequentially as growth rates normalize, following the benefit from third-party partnerships noted earlier. Growth will continue to be driven by volume and revenue per search across Edge and Bing. And in Xbox content and services, we expect revenue to decline in the low to mid-single digits against a prior year comparable that benefited from strong first-party performance, partially offset by growth in subscriptions. And hardware revenue should decline year over year. And in closing, demand signals across bookings, RPO, and product usage are accelerating faster than we expected. We're investing in infrastructure, AI talent, and product innovation to capture that momentum and expand our leadership position. And we remain focused on delivering real value to our customers that results in durable revenue growth for the long term. With that, let's go to Q&A, Jonathan.
Thanks, Amy. We'll now move over to Q&A. Out of respect for others on the call, we request that participants please only ask one question. Operator, can you please repeat your instructions?
I won't be doing that. I'm going to ask 10 questions.
If you would like to ask a question,
3-part questions
*1
each.
on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press *2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. And our first question comes from the line of Keith Weiss with Morgan Stanley. Please proceed.
Excellent. Thank you guys for taking the question, and congratulations on another outstanding quarter. And if I'm looking at Microsoft, this is 2 quarters in a row. We're really seeing results that are well ahead of anybody's expectations when we were thinking about this company a year ago or 5 years ago. 111% commercial bookings growth was not on anybody's bingo card, if you will. Yet the stock is underperforming the broader market. And the question I have is kind of getting at the zeitgeist that I think is weighing on the stock. And is something about to change? And I think AGI is kind of a nomenclature, a shorthand for that. And it's something that's still included in your guys' OpenAI agreement. So Satya, when we think about AGI or we think about how application and computing architectures are changing, is there anything that you see on the horizon, whether it's AGI or something else, that could potentially change what appears to be a really strong positioning for Microsoft in the marketplace today, where that strength will perhaps weaken on a go-forward basis? Is there anything that you're worrying about?
Yes, we're going to weaken
that evolution, and particularly the evolution of these generative AI models?
No, thank you, Keith, for the question. So here's how I would say that I think there are 2 parts. We feel very, very good about even this, I'd say, the new agreement that we now have with OpenAI, because I think even it just creates more certainty to all of the IP relationship we have as it relates to even this definition of AGI. But beyond that, I think your question touches on something that's pretty important, which is how are these AI systems going to truly be deployed in the real world and make a real difference and make a return for both the customers who are deploying them and then obviously the providers of these systems? And I think the best way to characterize the situation is that even as the intelligence capability increases, let's even say exponentially, like model version over model version. The problem is it's always going to still be jagged, right? I think the term people use is the jagged intelligence, or spiky intelligence, right? So you may even have a capability that's fantastic at a particular task, but it may not uniformly grow. So what is required is, in fact, these systems, whether it is GitHub Agent HQ or the M365 Copilot system. Don't think of this as a product. Think of it as a system that in some sense smooths out those jagged edges and really helps the capability. I mean, just to give you a flavor for it, right? So if I am in M365 Copilot, I can generate an Excel spreadsheet. The good news is now an Excel spreadsheet does understand Office.js, has the formulas in it. It feels like, wow, it is a great spreadsheet created by a good modeler. The more interesting thing is I can go into agent mode in Excel and iterate on that model. And yet it'll stay on Rails. It won't go off Rails. It'll be able to do the iteration.
How do I do
Then I can even give it to the analyst agent, and then it'll even make sense of it like a data analyst of an Excel model. The reason I say all of that is because that's the type of construction that will be needed, even when the model is magical, all-powerful. I think we will be in this jagged intelligence phase for a long time. So one of the fundamental things that whether it's GitHub, whether it's security, whether it's M365, the three main domains we're in, we feel very, very good about building these as organizing layers for agents to help customers. And by the way, that's the same thing that we're going to put into Foundry for our third-party customers. So that's kind of how people will build these multi-agent systems. So I feel actually pretty good about both the progress in AI. I don't think AGI, as defined at least by us in our contract, is ever going to be achieved anytime soon. But I do believe we can drive a lot of value for customers in AI models by building these systems. So it's kind of the real question that needs to be well understood. And I feel very, very confident about our ability to make progress.
Allahu Akbar.
Excellent. That's super helpful.
He's Indian, dude.
Thanks, Keith. Operator, next question, please.
The next question comes from the line of Brent Thill with Jefferies. Please proceed.
Third party customer.
Thanks, Amy, on the bookings blowout. I guess many are, somewhat concerned about concentration risk.
Brent's always glazing.
And I think you noted a number of $100 million contracts. Not to go into a lot of detail, but can you just give us a sense of what you're seeing in that 51% RPO and 110+% bookings growth that gives you confidence about what you're seeing in terms of the breadth and
that's Unk? That's Unk mode?
These deals on a global basis. Thanks.
Unk.
Thanks, Brent. A couple things to maybe take a step back on RPO.
Raised CapEx spending.
With a nearly $400 billion balance, we've been trying to help people understand sort of how to think about really the breadth of that. It covers numerous products. It covers customers of all sizes.
I don't think so.
That's been a balance that we've been growing, obviously, at a good clip.
I really want to smoke
what
meats
people need
here.
to realize is
That's the key.
it sits across multiple products because of the things Satya's talking about around creating systems and where we're investing. And if you're going to have that type of balance, and then more importantly, have the weighted average duration be 2 years, it means that most of that is being consumed in relatively short order. People are not consuming, and I say this broadly, unless there's value. And I think this is why we keep coming back to, are we creating real world value in our AI platforms, in our AI solutions and apps and systems? And so I think the sort of the way to think about RPO is it's been building across a number of customers. We're thrilled to have OpenAI be a piece of that. We're learning a ton and building leading systems because of it that are being used at scale that benefits every other customer. And so it's why we've tried to give a little bit more color to that RPO balance, because I do understand that there have been a lot of concerns or questions about, is it long dated? Is it coming over a long period of time? And hopefully this is helpful for people to realize that these are contracts being signed by customers who intend to use it in relatively short order. And at that type of scale, I think that's a pretty remarkable execution.
Thank you.
Thanks, Brent. Operator, next question, please.
Why aren't they asking about brisket?
The next question comes from the line of Mark Mordler with Bernstein Research.
Mark
Please
Mordler.
Thank you very much for taking my question, and congratulations on the quarter. It's pretty amazing what you guys are doing. Satya and Amy, I'd like to ask you the number one question I receive, whether from investors or at AI conferences I attend. How much confidence do you have that the software, even the consumer internet business, can monetize all the investments we're seeing globally, or frankly, are we in a bubble? In fact, Amy, what would be the factors you'd be watching for to assure that you're not overbuilding for current demand and that demand will sustain? Thank you.
Why were you in a bubble?
Maybe I'll start, Satya, and then you could add. Let me talk a little bit about maybe connecting a couple of the dots, because with $400 billion of RPO, that's sort of short dated, as we talked about. Our needs to continue to build out the infrastructure is very high. And that's for booked business today. That is not any new booked business we started trying to accomplish on October 1st, right? And so the way to think about that, and you saw it this quarter in particular, and as we talked about 26, the remainder, number one, we're pivoting toward increasingly, we talked about this, short-lived assets, both GPUs and CPUs. Again, we talk about all these workloads are burning both in terms of app building. Now, when that happens, short-lived assets generally are done to match sort of the duration of the contracts or the duration of your expectation of those contracts. And so I sometimes think when people think about risk, they're not realizing that most of the lifetimes of these and the lifetimes of the contracts are very similar.
What do you mean?
And so when you think about having revenue and the bookings and coming on the balance sheet and the depreciation of short-lived assets, they're actually quite matched, Mark. And as you know, we have spent the past few years not actually being short GPUs and CPUs per se. We were short the space or the power is the language we use to put them in. So we spent a lot of time building out that infrastructure. Now we're continuing to do that, also using leases. Those are very long-lived assets, as we've talked about, 15 to 20 years. And over that period of time, do I have confidence that we'll need to use all of that? It is very high. And so when I think about sort of balancing those things, seeing the pivot to GPU, CPU, short-lived, seeing the pivot in terms of how those are being utilized, we are, and I said this now, we've been short now for many quarters. I thought we were going to catch up. We are not. Demand is increasing. It is not increasing in just one place. It is increasing across many places. We're seeing usage increases in products. We are seeing new products launch that are getting increasing usage and increasing usage very quickly. When people see real value, they actually commit real usage. And I sometimes think this is where this cycle needs to be thought through completely, is that, when you see these kind of demand signals and we know we're behind, we do need to spend. But we're spending with a different amount of confidence in usage patterns and in bookings, and I feel very good about that. I have said we are now likely to be short capacity to serve the most important things we need to do, which is Azure, our first-party applications. We need to invest in product R&D, and we're doing end-of-life replacements in the fleet.
Everybody's short capacity.
So we're going to spend to make sure that happens. It's about modernization, it's about high quality, it's about service delivery, and it's about meeting demand. And so I feel good about doing that, and I feel good that we've been able to do it so efficiently and with a growing book of business behind it.
Yeah, the only thing I would add to what Amy captured was, if you sort of look out, there are two things that matter, I think, and that critical in terms of how we think about our allocation of capital, also our R&D. One is how efficient is our planet scale token factory, right? I mean, that's at the end of the day what you have to do. And in order to do that, you have to start with building out a very fungible fleet.
Very fungible.
It's not like we're building one data center in one region in the world that's mega scale. We're building it out across the globe for inference, for pre-training, for post-training, for RL, for data science, what have you. So therefore, the fungibility is super important. The second thing that we're also doing is continually modernizing the fleet. It's not like we buy one version of, say, Nvidia and load up for all the gigawatts we have. Each year you buy, you ride the Moore's law, you continuously modernize and depreciate it. And that means you also use software to grow efficiency. I talked about, I think, 30% improvement on both serving up GPT-4.1 and 5.0, right? That's software. That's sort of, and by the way, it's helpful on A100s. It's helpful on GB200s, and it'll be helpful on GB300s. That's the beauty of having the efficiency of the fleet. So keep improving utilization, keep improving the efficiency. So that's what you do in the token factory. The other aspect, which Amy spoke to, is we have some of the best agent systems that matter in the high-value domains, right? It's in information work. That's the Copilot system. Coding. I should also say one of the things I like about Copilot is, Copilot ARPUs compared to M365 ARPUs, right? It's expansive. The same thing that happened between server and cloud, like we used to always say, well, is it zero sum? It turned out that the cloud was so much more expansive to the server market. The same thing is happening in AI, because first you could say, hey, our ARPUs are too low when it comes to M365, or you could say we have the opportunity with AI to be much more expansive. Same thing with tools, right? Tools business was not like a leading business, whereas coding business is going to be one of the most expansive AI systems. And so we feel very good about being in that category. Same thing with security, same thing with health. So we have, and in consumer, one of the things is it's not just about ads, it's ads plus subscriptions. That also opens up opportunity for us. So when I look at the entirety of these high-value agent systems, and when we look at the efficiency of and fungibility of our fleet, that's what gives us the confidence to invest both the capital and the R&D talent to go after this opportunity.
That was pretty amazing. I really appreciate all the detail.
Thanks, Mark. Operator, next question, please.
The next question comes from the line of Karl Keirstead with UBS. Please proceed.
Okay, thank you. This one is for Amy. Amy, I certainly don't want to take you down a too complex an accounting path with this question, but the investment in OpenAI that sits in other income at $4.1 billion is so large that I think the audience listening in could benefit from a little bit more color about what that is. It feels like it's so much larger than you were running through other income in prior quarters that it mustn't just be your share of the OpenAI losses. So could you just describe that and what we can expect in subsequent quarters and whether this signals any kind of accounting change? Thanks so much.
The Q1 number was not impacted at all by the new agreement that was put in place. Let me first say that. Secondly, that increased loss was all due to our percentage of losses in OpenAI to the equity method. So just to be very clear. So there is not anything there that is not the increased losses from OpenAI.
Okay, understood. Thank you.
Thanks, Karl.
Thanks, Karl. Operator, next question, please.
The next question comes from the line of Mark Murphy with JP Morgan. Please proceed.
Thank you so much. So we seem to be entering into a new era where the contractual commitments from a small number of AI natives are just incredibly large, not only in absolute terms, but sometimes relative to the size of the companies themselves. For instance, contracts worth hundreds of billions of dollars that are 20 times their current revenue scale. philosophically, how do you evaluate the ability of those companies to follow through on these commitments? And how do you think about placing guardrails on customer concentration for any single entity?
Yeah, maybe I'll start and then maybe you can add. I mean, it goes back a little bit, Mark, to what I said about building first the asset itself such that it's most fungible. And then to recognize the strength of even sort of our portfolio. We have a third-party business, we have a first-party business, we have third-party also spread between enterprise, digital natives. I always felt that we need a balance there because it may start with digital natives. They're always going to be the early adopters. You always have the hit app of the generation, and then essentially then it spreads throughout. The enterprise adoption cycle is just starting. And so therefore having the over the arc of time, I think that third-party balance of customers will only increase. But it's great to have the hit first-party apps in the beginning because you can build scale that then if it's a fungible, and that's where the key is. You don't want to build for a digital native as if you're just doing hosting for them. You want to build. That's where I think some of the decision-making of ours is probably getting better understood. What do we say yes to? What do we say no to? I think there was a lot of confusion. Hopefully by now, anyone who's switched on will figure this out. And so that's, I think, one thing we're doing on the third party. But the first party is probably where a lot of our leverage comes. And it's not even about one hit app on our first party even. Our portfolio of stuff, which I just walked through in the earlier answer, gives us, again, the confidence that between that mix, we will be able to use our fleet to the maximum. And remember, these assets, especially the data centers and so on, are long assets, right? There will be many refresh cycles for any one of these when it comes to the gear. So I feel that, once you think about all those dimensions, the concentration risk gets, mitigated by being thoughtful about how you really ensure the build is for the broad customer base.
And maybe just to help with another angle of that, because I think Satya's helped a lot, is that, when you think about concentration risk or delivering to any customer, you have to remember that because we're talking about this very large flexible fleet that can be used for anyone and for any purpose, 1P, 3P, and including our commercial cloud, by the way, which I should be quite clear on, it is pretty flexible in every regard. You have to remember that the CPU and GPU and the storage gear doesn't come into play until the contracts start happening. And so you're right, some of these large contracts have delivery dates over time. So you get a lot of lead time in being able to say, oh, what's the status? And so I think we're pretty thoughtful around what's always gone in our RPO balance.
That we give them money for them to buy our stuff.
There's always been that taken into account when we publish that bookings number and publish the RPO balance.
Commercial cloud.
Thank you very much.
Thanks, Mark. Operator, next question, please.
It's a fleet.
The next question comes from the line of Brad Zelnick with Deutsche Bank. Please proceed.
Great. Thanks so much for taking the question, and I'll echo my congrats on an amazing start to the year. Amy, is there any way to quantify or frame the revenue impact of Azure being short on capacity? And while I appreciate the constraints you face are broad across the industry, is there risk of workloads going elsewhere, and how do you mitigate that?
Yeah, Brad, it's a great question. It's always hard to quantify precisely what would have been the revenue impact in quarter. But I would offer a way to think about it is, Azure probably does bear most of the revenue impact because when you think about real priorities that you have to fill first, it's obviously the increasing usage and adoption and sales we've seen of M365 Copilot and the usage of Copilot Chat, which we've seen very different patterns, which we're encouraged by. It's the adoption of security features. It's the GitHub momentum. And so when you're thinking about it, that is where, and it is a priority for us to allocate resourcing there first. And so you're all right to ask, how do I think about that? We've worked very hard to try to mitigate it as best we can, but we have been short in Azure, and we've been clear on it. And I would say the other two priorities that I haven't mentioned maybe as much before is also just making sure our product teams and the AI talent that we've been able to hire into the company really over the past year and a half have access also to significant capacity, because we're seeing it make the product better in a loop that is adding great benefit today into products people are using today for real world work. And so we are making that a priority to make sure our research teams have that, as well as our product engineering teams. And yes, it does impact Azure directly. That is the place where you see that prioritization. But I think it's probably hard for me to give an exact number, but it is safe to say that the number could be higher.
Great, thank you.
Thanks, Brad. Operator, we have time for one last question.
The last question will come from the line of Kash Rangan with Goldman Sachs. Please proceed.
Thank you very much. Amy, I just wanted to congratulate you. I think you said before that it is possible to accelerate Azure growth while getting efficient with margins, and you've done it. Congrats on that. I have one for you, Satya. With respect to the elephant in the room, just being a little more direct, following up on Keith Weiss's question, there's talk that another hyperscaler came in and took away the business that was rightfully Microsoft's. I'm sure that there is a different point of view here. I'm wondering if you could offer some perspective on your criteria is it about a certain volume of business that you wish to execute on the Microsoft paper, or is it something broader than that I don't think maybe people fully appreciate the terminal value that Microsoft will have on its balance sheet at the end of these contracts, which I think is probably being underestimated as you have the full stack and you've got the multiple vectors to monetize, be it databases, Foundry, and to your point that you are a platform company, not just a hyperscaler. Maybe that's what it is all about, or maybe there's another story about you letting the other hyperscaler company come in from nowhere and claiming a big piece of that 4 to 5 year puzzle. Thank you so much once again. Really appreciate it, and congratulations.
Well, thanks, Kash. I mean, for us, again, it just always goes back to, I think, the core principle, which is build a fleet that is fungible across the planet and works for third party and first party and research. So that's essentially what we have done. And so when some demand comes in shapes that don't fit that goal, where it's too concentrated, not just by customer, by location, by type of skewing, right? I think Amy mentioned some very key things. When you think about the margin profile of a hyperscaler, you've got to remember this, the AI accelerator piece, but there's compute, there's storage. And if all of the demand just comes for just 1 meter, that's really not a long-term business we want to be in. That's even from a third party. We have to balance it with all of our first party stuff, because that's, after all, a different margin stack for us. And then we have to fund our own R&D and model capability, because in the long run, that's what's going to differentiate us. And so I look at all of those. We sort of use all of that to make sure we are saying yes to all the demand that we want. We say no to some of the demand that may be something that we could serve, but is not in our long-term interest. And so that's sort of the decision-making we've done. And we feel very, very good about the decisions. In some sense, I feel even each time we say no to, the day after, I feel better.
And Kash, maybe just
very clear.
Yeah. And just Kash, I think this is our last call with you, and I just want to say thanks and congratulations. It's been a privilege to work with you, and best of luck.
Let me add to that. Best of luck, Kash.
Thanks. Thank you so much. Very kind of you.
What's Kash doing?
Thanks, Kash. That wraps up the Q&A portion of today's earnings call. Thank you for joining us today, and we look forward to speaking with all of you soon.
Thank you all.
Thank Thank you. This concludes today's conference.
Fungible.
You may disconnect your lines at this time.
Is your
Thank
fleet
you for your
fungible?
participation.
Or is it non-fungible? Like an NFT? If it's not fungible, we're not interested. Come over here. Are you fungible? Let me check. Take off your pants. Yes. I want to serve you on the cloud. Indeed. So fungible. Bring me that fungible. Bring me my fungibles, thank you. Where's my fleet? It really does sound like Star Wars. I'm gonna say fungible now for the next fucking year. Somebody's gotta stop Visa, man. These guys make way too much money. Is it fungible? Or is it not? I don't know. You guys might catch my son, my baby boy, coming over to the office here. Big data. Big data. Big data. Big data. You want to meet in the war room? No. You want to meet conference room B? Big data. I hate Thai food. You gotta understand, I don't like anything spicy or anything fucking even remotely interesting. I like cardboard to eat. Ooh. Combis. How are you? Stream looks great. Yeah, I think today was a good down day. But well, maybe quantum will go down tomorrow. I don't know. It's been tough. It's been ping-ponging. Snappier and crisper with the fleet of non-fungible machines. I like Chinese food. I'm actually really hungry. If you don't know what EPS is, maybe you should shut the fuck up. The average top company in the world is trading at 30 times. This is crazy. I have one business and I'm working on it as we speak. $10 times sales and 30 times next year's earnings. Oof. What is EPS?